Good afternoon, Sakunthala ji. Good afternoon to everyone. Sonia ji, Nisha ji, requesting all the participants till the time everybody is joining.
Good afternoon, ma'am.
Good afternoon, everyone.
Good afternoon, ma'am.
Good afternoon. Let's begin the session till all our participants are joining. Very good afternoon to the esteemed faculty for the first session, CS Sakunthala ji.
Yes.
I also welcome CS Sonia Arora ji, the chairperson from the Jalandhar branch, Women Empowerment Committee convener CA Nisha Patel, all my lovely participants, Jigna, Pranali, Bosky, a very, very warm welcome to all of you. I know you all have just finished the lunch and would be in a rush that I need to start, I need to attend the session, but I must congratulate all the participants' commitment that even in these difficult times and where you all are making a right decision of upgrading yourself. So a big congratulations to all of you for coming and attending this series. We have more than 55 participants in this series, and every one of us can individually also participate in this series. We have completed with the GST series, we have completed with the audit series, and today we are beginning with the income tax series, and we are also grateful to all the faculties across the nation for giving us prompt support and sharing their valuable time. Now let's begin the session. I would request Nidhi Ben to play ICI motto. Request everyone to put their right hand on their heart for ICI motto. Nidhi Ben, are you there? Just a second.
Ma'am, yes, ma'am.
Yeah.
Wait for 1 minute. Huh?
Yeah. Nidhi Ben. Nidhi Ben, are you there?
Yes, ma'am.
Yeah, please start the ICI motto. Nidhi Ben, we cannot hear the ICI motto.
यैषत्सुप्तेषु जागृति यैषत्सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूदास्यति कश्चनास्यति कश्चन एतद्द्वैता 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 एतद्द्वैता
Sorry for the technical glitch. जितना टेक्नोलॉजी आगे बढ़ता है, it comes with its own problems. Welcome back. We have Chairperson CA Sonia Arora from Jalandhar branch. Even the Jalandhar branch is associated with us for the Women Refresher series, along with other branches. So I would now request Sonia ji to share few words.
Thank you, Anjali ma'am. Firstly, I extend my gratitude towards Ahmedabad branch for giving me the wonderful opportunity to interact with you all. And the salute to the branch for the commendable work you are doing. And the initiative to start this refresher course for the women is just like a ray of hope for all to bring themselves abreast with all the latest amendments. The female, due to certain responsibilities or priorities, have to take a break from their work, and that make difficult for them to cope up with the frequent and vast amendment in the laws, leading to their low confidence, I say. So I must say it's the need of the hour, and that with these sessions will be conducted on a regular basis, and all of you must participate in them. And for the women, we whatever we thought, लोग हमारे बारे में क्या सोचेंगे, अरे अगर ये भी हम सोचेंगे तो वो क्या सोचेंगे, इसीलिए इसे सोचना बंद करें. And only 2 lines for you all. खुल जाएंगे सभी रास्ते, तू रुकावटों से लड़ तो सही. खुल जाएंगे सभी रास्ते, तू रुकावटों से लड़ तो सही. सब होगा हासिल तुझे, तू अपनी जिद पे अड़ तो सही. We are so determined and passionate and think whatever women want, they are going to rock. And believe me, you all are rocking and will definitely work and do wonders. Thank you, ma'am. Thank you, Anjali ma'am. And I think inspiration is for all is Anjali ma'am too, as rocking all the time. Thank you, ma'am.
Thank you, Sonia ji. Wonderful. इंस्पिरेशन की डोज 1 मिनट में आपने हमको दे दी है. And we are always grateful for your motivating words, for your inspiring shairis. And you can see all the candidates, Monica, Jigna, Bosky, they are all ready to take this challenge. हम कुछ भी हो जाएंगे, whatever difficulties we'll have. हमने ये डिग्री बहुत मेहनत से ली है, and we are going to do it at any cost. Thank you so much for your valuable time and presence. Taking the session ahead, I would now request CA Nisha Patel, the convener for the Women Empowerment Committee, to introduce the esteemed faculty for the first session, CA Shakunthala ji. And I'm really once again very much thankful to you, ma'am, for giving us prompt acceptance and taking part in this series. Thank you all. Wish you all happy learning and keep participating. That will motivate us to do more and more programs for you. Yes, over to you, Nisha Patel.
Thank you, Anjali ji, and thank you, Sonia ji, for wonderful words. Actually, indeed, Anjali Choksi is a true inspiration for all of us. She is conducting on and off every day. There is something new for all of us. So she is really very enthused, and that is the reason all this stuff is going on. So we are very thankful to her and even to you for giving your this valuable time to us. Thank you very much. And thank you for giving me this honor to introduce Ms. Shakunthala ji. Hello, Ms. Shakunthala ji. How are you?
Hello, ma'am. Hello, fine.
It's an honor introducing you, Ms. Shakunthala ji. Ms. Shakunthala ji, she is FCA, ACS, and qualified registered valuer for financial assets and securities of Insolvency Bankruptcy Code of India. She is proprietor of Shakunthala and Associates, and practicing in the field of direct tax and indirect taxes, ROC related matters, concurrent audit of schedules bank, valuation of financial assets and securities. Shakunthala ji is graduated from PSGR, Krishnaval College for Women, Coimbatore. From 91 to 2001, for the period of 11 years, she served as quality control officers in Surya Prabha Mills Private Limited, Coimbatore. In 2006, that is, you please just listen it. In 2006, at the age of 36 years, she joined CA course. That's worth commendable. And in 2008, she joined CS course and started professional career. She handled various classes in indirect tax, direct tax, corporate management, accountancy, subjects for executive programs at ISI Coimbatore chapter. She addresses workshops on direct tax, indirect tax, Compliance Act 2013, and accounting standards at various colleges at Coimbatore. She addressed many seminars in GST and income tax at ICI and ICS chapter and at various other professional firms. She's member of Board of Studies of Commerce Department of Ramakrishna Mission Vidyalaya, Coimbatore. She's member of Studies of Commerce Department of PSGR Krishnamal College for Women, Coimbatore. She is registered valuer of securities of financial assets under Insolvency and Bankruptcy Board of India. She is a qualified woman director of Institute of Company Secretaries of India, and she's a professional independent director of Indian Institute of Companies Affairs. And above all, she's a proud mother of 2 sons. We are really honored, Ms. Shakunthala ji, for your presence. Actually, I'm really inspired, and I think all of us would be inspired that she started her CA at the age of 36 years. That's really, that's true inspiration for all of us, that we think about joining this refresher series at this age. We feel like what to do, and she joined CA at this age. So it's worth commendable. We are eager to listen from you, Ms. Shakunthala ji.
Yes.
Over to you. Please enlighten us with your esteemed knowledge. Thank you, Ms. Shakunthala ji. Over to you.
Thank you very much. Thank you, Nisha Patel ji, for your wonderful introduction. At the outset, I thank Ahmedabad branch of WIRC of ICI for conducting such a marvelous program for women. So it is a need of the hour for our women to come up with the knowledge to be enriched during the lockdown times, because at the office time, we won't be having time to even go through the books, acts, or circulars or notices. So with this program, we all can update with the knowledge of all the faculties who have been there in this course. So I'm very much proud to be a part of this program of women refreshment course, and I thank CA Hema ji, who had called me for taking up the session for income tax, and my regards to all the chairpersons of all host who has been taking up this program along with the Ahmedabad branch. So thank you all. I'm really honored to be a part of this program. My presentation will be on income tax amendment of Finance Act 2021. As Nishaji has introduced, my comeback at 36 was my professional career. So I had an ambition of doing CA at the right age of 8th standard. Due to my early marriage, I couldn't take up that course at the age of 21, since I got married at the age of 21. So after my 2 kids have been born and my first son who had crossed 10th standard board exam, thereafter I was free and I joined this course, and I've been taking up seriously. And now every amendments and thing I used to take up, because both the sons have been grown up, so I've got much free time to take full part in the profession. So with the God's blessings and with wishes of all of you, I've been going forward, and this opportunity which was being given by Ahmedabad branch has been quite inspiration for me to go forward in my career. Thank you so much. Now I shall share my screen for my presentation. The topic given to me is a very vast as such: amendments in Finance Act 21 and the changes in ITR. I'll see that I'll keep up my time till 2:30. If not possible, I'll stop my presentation with that. I'll share my PPT with all of you so you can go through that. It's only mere sharing of knowledge. So anything, any wrong point, anything is being told by me, I stand corrected for that. So with the humbleness, I start my presentation in today's topic. I'll share my screen just for a minute. Yeah, able to see my screen, ma'am? Yes?
Yes, ma'am.
Yeah.
Yes, ma'am.
Shall I go forward with my presentation? Yeah, now going forward with the presentation, today's topic being income tax amendments in Finance Act 2021 and changes in ITR as such, right? So for today's discussion, we'll be having introduction to Finance Act 2021 because Finance Act 2021 is unique of its nature. As far as the Finance Act is concerned, it is an unique for every year as such, especially for Finance Act 2021. It is being a special unique, having so many changes in this particular act. New sections were being introduced in this act. Amendments in the sections have been made, in various sections amendment have been made, and changes in ITR. So for today's discussion, we'll be having all these topics as such. Going forward with the introduction, I told the Finance Act is an unique by its own, since it has been changes of 100 changes have been proposed in the union budget by our Honorable Finance Minister, Mrs. Nirmala Sitharaman, and 100 other changes were presented and passed also in the Parliament. And moreover, some amendments have been made in the existing laws to be taken up, and some changes have been introduced to unsettle the settled laws. So the introduction being is a lengthy one, just to give a overview, I have given this small introduction to you. Now going forward for the new sections which is being introduced in Finance Act 2021 is section 229A, meaning of liable to tax. This is a new section introduced. Section 9B introduced relating to the reconstitution and dissolution of the firm. Section 144B regarding faceless assessment. So this is a new feature which is being taken up. And section 194P regarding deduction of tax in case of senior citizens. Section 194Q, TDS on payment for purchase of goods. Section 206AB, TDS on non-filers of income tax returns. Section 206 CA, TDS on non-filers, TCS on non-filers of income tax returns. Section 245 AA for interim board for settlement of cases, and section 271K, failure to furnish the statement in respect of 80G and other 36(5)A. Now, all these sections have been newly introduced in this Finance Act. So we'll go through each one by one. Going forward with section 229A, meaning of liable to tax. So what does it mean actually? It means that there is an income tax liability to such person under the law of that country and shall include a person who has been subsequently been exempted from tax liability under the law of that country. So this is a wordings which has been put in this section of 229A. The main importance being given in this section is the meaning of liable to tax is being interrupted with the reference to a country as such. So in Finance Act 2020, where an Indian citizen who is not liable to tax in any other country or territory shall be deemed to be a resident of India if his total income, either other than the income from the foreign resources, exceeds 15 lakhs. Now it has been totally changed in Finance Act 2021, wherein the liability to tax is being interpreted with reference to a country as such. So it provides that the term liability to tax in relation to a person and with reference to a country, meaning where there is an income tax liability on such person under that law of that country for the time being in force, and shall include a person who has been subsequently been exempted of such liability under the law of country. So this amendment, which is being brought in by introduction of section 229A, will stand good from 1st April 2021 and will be accordingly applied for the subsequent assessment years. Now, going forward for the section 9B, which is being introduced towards the reconstitution and dissolution of the firm, Here, the section is applicable at the time of dissolution and reconstitution as and when the partner receives any capital assets or stock in trade, fine. So there is a corresponding section amendment to 43 for 45(4) in capital gain. So we'll see in later slides where it has been amended. It shall be deemed that the firm has transferred such capital assets or stock in trade to the partner in the year the partner receives such capital assets or stock in trade. So this section 9B is being newly introduced as such. So what does a reconstitution mean? So that also we'll see elaborately here. So any profit and gain which is being received on such deemed transfer or the dissolution or reconstitution of the firm shall deem to be the income of the firm and shall be chargeable under capital gain for the transfer of capital assets or under business and profession on transfer of stock in trade. Fine. So for the consideration, what will be the consideration? The consideration will be the fair market value on the date of receipt, which shall be considered as a consideration in the year in which the particular transfer is being taken place. Now, moving forward, what is a reconstitution as such? We all know very well. We're brushing up. Reconstitution means if one or more partners ceases to be a partner of a firm, one or more partner admitted as a partner in the firm, all the partners remain there, but only the change in the profit sharing ratio. So this is a reconstitution which is being taken up under section B, which has been newly introduced. Now, with regard to the 45(1)B, capital gain on ULIP, which is nothing but unit link insurance policy. This is a new section being introduced. Why? Because this under section 1010D, what does it says? It exempts on the proceeds which is being received on the maturity of life insurance policy. Now, ULIPs, when the premium are being paid on ULIPs, when the premium crosses 2.5 lakhs in any of the previous years, the exemption is not applicable. In order to bring the taxation of that ULIP, new section 45(1)B has been introduced. There is an exception for this. When the maturity of ULIP is being received by the nominee on the death of a person, it is being completely exempted. Otherwise, in case of a ULIP at the time of maturity under section 45(1)B, which is being newly introduced, it is being taxable under the head capital gain. Now, going forward for section 144B regarding the faceless assessment, which we are all facing from the assessment year 2021 itself, that is the new 144B which is being introduced. This section was being inserted by the Taxation and Other Laws Relaxation and Amendment of Certain Provision Act 2020 with respect to 1/4/2021. Right? So to eliminate the human interference and to increase the transparency of the disposal of appeals, the National Faceless Tribunal Center will be constituted and all the communications will be taken up faceless with ITAT and other and assessee as such. Right? So the government has already introduced, we have been seeing from the last assessment year wherein the filing of even Form 35 is being done online and the assessment is being taken up online. And in case where the assessment is necessary, where personal hearing is to be brought in, then it will be taken up through video conferencing as such. Now this section 144B is being introduced wherein it contains the complete procedures regarding to the faceless assessments like under which section this assessment will be covered, how the notices can be issued and how replies should be filed, etc. Right? So these all will be taken up in 144B. Now, going forward for 194P exemption for ITR filing for senior citizens, which is being newly introduced as such. So section 139, as we all know, income tax returns has to be furnished by each and every individual if his total income exceeds the basic limit within the due date. Section 194P, which is being newly introduced, will provide and relief for filing of return who are being the age of 75 or more. Now we'll see what are all the compliances to be taken up in order to avail this exemption as such. So exemption to be taken up, senior citizen should be of age of 75 or above. Senior citizen should be a resident of India in the previous year. He has no other income except the pension income and the interest income. If he has an income under house property or a capital gain or any other income as such, winning from lotteries or income from other sources, apart from this interest income, he cannot claim the exemption under 194P. Interest income accrued and earned from the same specified bank. This is to be particularly noted, in which he is been receiving his pension. So it is not possible at all wherein all the senior citizens or individual like us, we are having at least 2 or 3 bank accounts wherein interest is being earned. So I think with this phrase, the entire 194P cannot be utilized by the senior citizens, but still, wherein the senior citizens are having only one bank account with the specified bank wherein they are getting the pension, this exemption can be availed. The senior citizen will declare to its bank containing the details of Chapter 6A deductions and the rebate allowable under 87A. Now the challenge comes here. Now, only we professional can have a full guidance of Chapter 6A and the rebate allowance under 87A, wherein the rebate allowance is being changing from year to year. As last year we had 7,500 and for this year we have 12,500. So this part of professional advice can be given only by we professional, and we have to wait and see how the bankers take upon with these Chapter 6A deductions and the rebate allowable under 87A. They should declare that they have not earned any other income except the pension and the interest income. The bank is a specified bank as notified by the central government. So this is also a big challenge. The bank wherein notified by the central government, in that specified bank only the particular person has to receive a pension and the interest income as such. Such banks will be responsible for tedious deduction of senior citizens after considering the deductions under Chapter 6A and the rebate under 87A. So if all the conditions have been satisfied, then the senior citizens who have been attained the age of 75 years, they can be exempted from filing the return. So it is a big challenge for senior citizens and the bankers as such, because they have to break their head with the calculation of 6A deductions and rebate allowable under 87A, but naturally these persons will come to us for at least a computation so that they will know whether they are being taxable under this 194P or not. Right? Now going forward with 245 AA for the interim board of settlement cases. So this new section is being introduced wherein the settlement commission, the income tax settlement commission, ceases to operate from 1/2/2021, and now the central government is being empowered to notify a scheme for the settlement in respect of the pending cases, and this can be done only by the institution of interim board, which shall be constituted for the settlement of pending of cases. Fine. Now going forward with 271K, failure to furnish the returns. This is a new section introduced without prejudice to the, this is being told in the section itself, without prejudice to the provisions of this act, the assessing officer may direct that sum not less than 10,000 rupees, but which may be extended to 1 lakh and shall be paid by way of penalty in the case where research association, university, college, and other institutions referred to in clause 2 or clause 3 or company referred to in clause 2A of subsection 1 of section 35. So they have to furnish a statement which is being prescribed in this section. If they are not prescribed that particular statement or not submitted, they will be imposed a penalty of not less than 10,000 rupees, which may be extended to 1 lakh rupees. Going forward, an institution or fund, if it fails to deliver or cause to deliver a statement within the time prescribed. So this is a new clause which is being introduced, wherein the NGOs and trusts who have been offering or accepting donation under the subsection 80G, they have to furnish a certificate. Even those, when they fail to submit a required statement as per the prescribed in this section, even they are being eligible for the penalty which can be imposed by the assessing officer as such. Now going forward towards 194Q, TDS on the payment of purchase of goods. I'll run through with the TDS part because next speaker will be taking up the TDS part in detail. Any person who is a buyer or responsible of making any payment to a resident seller on a purchase of goods shall deduct a TDS of 0.1% when the aggregate value exceeds 50 lakhs. The buyer can deduct only when its turnover in the immediately preceding previous year, not this year, previous year, exceeds 10 crores. If the TCS is being already taken up at 206C1H and 206C, this section will not apply. So a new section 194Q is being taken up. Going forward for 206AB, TDS on non-filers of income tax return. This is quite interesting, wherein we have been seeing where the TDS credit is being given for an individuals, and in their particular 26 years TDS is being there, but still those individuals are not filing the returns, saying that they are being below the exemption limit, basic exemption limit. Now, this section is applicable when the tax is required to be deducted under section 17B, other than 192, 192A, 194B, 194BB, 194LBC, or 194N, the tax shall be deducted at the higher of the following rates, at the twice of the rate specified in the relevant provision of this act, at the twice of the rate in force, and at the rate of 5%. So this is for the non-filers who have been not filing in spite of having a credit under 26 years. Going forward for 206AB TDS not filers, this section is applicable who has not filed the return of income in 2 assessment years relevant to the 2 previous years, wherein their 26 AA statement credit is being given. So the aggregate of TDS and TDS will be 50,000 or more. Then only they are being non-filers and they have to comply with this provision as such. Fine. Now, this does not include a non-resident who does not have a permanent establishment in India. Going forward for 206 CCA, TCS or non-filers of income tax return. Previous section was for TDS, now it is for TCS. Here also the same thing is being told. This section is applicable where the tax is required to be collected under section 17BB. The tax shall be collected at the higher rate of twice of the rate specified in the provision at the rate of 5%. And even this is not been applicable to a non-resident who does not have a permanent establishment in India. So for TDS and TCS non-filers, the new provision is being introduced for the rate of tax. Now, amendment in existing sections. So far we have seen with respect to the new sections introduced. Now we'll go for the amendments in the existing section. Amendment in 1010D, amendment in 1011, amendment in 1012, amendment in 11.1, amendment in section 32 class 2, explanation 2 inserted in section 36(1)(5)(a), and limit increased in 44AB. Fine. So we'll see each one by one elaborately. So we have still more. Removed LLP for section 44ADA, amendment section in 45(4), amendment in section 50B2, amendment in section 55(2), all new provisions on 80G Clause 8 and Clause 9. This is a new thing which has been introduced here, and we have to all comply with this at present. Rental housing project section 80 IBA and income escaping assessment section 147. So in detail going forward in amendment in section 1010D, as I told earlier, 1010D was towards an exemption on receiving the maturity of life insurance policy. Now, this will not be available for unit-linked insurance policy on or after 1/2/2021 if the premium exceeds 2.5 lakhs in any of the previous year. If there are more than one ELIP, put together only 2.5 lakh exemption is being applicable. Going forward for section 1011, this is towards the contribution relating to the Provident Fund. This clause has been inserted, which shall not be available, the exemption which shall not be available where the interest income accrued to the assessee during the previous year to the aggregate amount of contribution made by the assessee exceeds 2.5 lakhs. So we can naturally see that every individual on basic salary will be contributing not more than 1.5 lakhs, but still there are employees in MNC companies who have been contributing more. In that case, when the interest income accrued, the exemption will not be applicable under section 1011, right? So this comes into effect 1/4/2021. If there is no contribution made by the employer as such, then this 2.5 lakhs shall be read with the 5 lakhs in the said section as such. Going forward for amendment in section 1012, this is towards the contribution towards recognized provident fund. So here also the same thing is being told, wherein the exemption under section 1012 shall not be available where the interest income accrued to the assessee during the previous year contribution made to the recognized provident fund exceeds 2.5 lakh rupees, which will come into effect from 1/4/2021. Where there is no contribution, the 2.5 lakh shall be read with the 5 lakh. Amendment in 11.1, going forward with that, two new explanations have been introduced, explanation 4 and explanation 5. With respect to explanation 4, to determine the amount of application for charitable and religious purposes from the corpus shall not be treated as an application of income. So meaning where any application which is being taken from the corpus fund of an NGOs or trust, that application will not be considered as an application of income in the current year. Application of charitable or religious purposes from any loan or borrowings, when the NGOs and trusts, they avail loan from any persons, from trustees or from the financial institution, and with that loan, if they have application of charitable purposes, that will not be treated as an application of funds as such. Now going forward towards explanation 5, for the purpose of section 11.1, the calculation of income required to be applied for accumulated during the previous year shall be made without any set-off or any deduction or any allowances of excess application. So this is quite a not welcoming part, wherein without setting off the losses of the previous year and without claiming the deductions or without allowances of excess application of the earlier year, explanation 5, which is being amended and inserted. So we have to wait and see how it shall be taken up with the NGOs and trusts, and it is challenging to our professionals to have a calculation with respect to explanation 4 and explanation 5. Going forward with the changes in the list of intangible assets. So this is a very interesting part. Goodwill of the business or profession is now removed from the list of intangible assets as listed in 32 class 2. So in case of individual proprietors and LLPs, no problem at all. We can easily remove that as per the amendment has come. But in case of Companies Act in Schedule 3, it is not been said that. So there has to be a parity between the income tax and the Companies Act Schedule 3. So it's a challenging part on our professionals to have a calculation over that. Since it is not in the list of 32 class 2, no depreciation will be charged on the same from first day of April 2021. So while calculating computation, we have to be very careful that see that the goodwill has to be removed as is being taken away from the list under section 32 class 2. Now, explanation 2, which has been inserted in 36(1)(5)(a), what does it say? This is a clarifactory in nature, which says that the provision of 43B, this is being given in the section as such, shall not apply and shall deem to be never have been applied for the purpose of determining the due date under section 36(1)(5)(a). So what is this 36(1)(5)(a)? It is nothing but the deposit of employees' contribution towards the respective fund by the employer. Since the employers are not depositing and they have been keeping with themselves, in order to curb that practice, this explanation 2 has been introduced, wherein what does the 43B says? It says in the year of deposit to the certain funds, the employer's contribution and employee's contribution, the deductions by the assessee can be availed in the profit and loss account. Now 36(1)(5)(a) is being amended with the new explanation 2 saying that 43B will not be applicable, meaning where if the amount is not being deposited in the specific fund, the deductions will not be availed in the current year. And even if in the next year it is being availed, it has to forego that deduction even in the further assessment years in which it is being deposited. So consequence amendment is being made in 43B by inserting explanation 5. So to have a more clarity on this, it is an employee's contribution to the specific fund as such, which has to be deposited in the specific fund in then and there assessment year itself in order to claim the deduction. If they have not deposited, they have to forego the deductions under profit and loss account. Fine. So this is being welcoming part, but still on the part of companies, it is being pressure on them to deposit the amount in the specific funds as such. Now going forward towards the limit increase in section 44AB, as we all know, 44AB is being applicable to all the persons to get the books audited if the total sales turnover and gross receipt exceeds 1 crore. In Finance Act 20, it is the 1 crore is being extended to 5 crores if the cash receipts and the payment made during the year does not exceed 5% of the total receipt and total payment respectively. Now in Finance Act 2021, the exemption is being still forwarded from 5 crores to 10 crores, wherein the turnover limits if the cash receipt and the payment does not exceed 5% of total receipt and total payment respectively. Now a new clause which is being introduced here, the second provision inserted to this section says that the payment or receipt settled through a non-accounting pay check and non-accounting pay draft shall be deemed to be a cash payment. So all RTGS and all other payments which is being directly deposited will also be considered as a cash receipt and the cash payment as such. Now going forward for amendment in 45(4), we have seen already, but to have where the partner receives, this is in connection with the 9B, which we have seen earlier, a new section introduced, where a partner receives any money or capital assets on the reconstitution of the firm, the profit shall, or from the such receipt shall be under the capital gain in the hands of the firm. To calculate that profit, the formula is given in the section itself. A is equal to B plus C minus D, wherein A is the income chargeable to tax, value of the money received plus the fair market value of capital assets plus minus the amount of capital balance of the partner in the books of the firm. So this is being given in the section itself. So we have to be very careful in case of dissolution and the reconstitution of the firm. This is read with the 9B section introduced. Now going forward for amendment in section 50B to slum sale, wherein the amendment is being given. Earlier, the capital gain on slum sale transaction was being undertaken as being the difference between the actual sales and the net worth. What was the net worth on that day? Net worth is equal to cost of acquisition plus cost of improvement. Now, amendment has been made wherein in relation to the capital asset for undertaking of slum sale, the net worth of undertaking or the fair market value of the capital assets on the date of transfer calculated a prescribed manner shall be deemed to be full consideration received for such transfer of capital. Fine. So this amendment in explanation 2, while calculating the net worth, if the capital asset is other than the goodwill purchased, the value shall be taken as the nil. So in case the capital asset is a goodwill, its value is to be treated as nil. If it is being acquired, then the purchase of the previous owner will be taken into consideration. Right? So this will, a challenge to be taken up under this is, this will increase the capital gain arising in mergers and acquisition transaction. So this is being, we have to wait and see how this challenge is being taken up by the companies in case of a slum sale of an undertaking. Now going forward with amendment in section 55(2) cost of acquisition. Now cost of acquisition subsection 2A is in relation to a goodwill, trademark, brand name, etc. If it is being acquired by the assessee from the previous owner, the purchase price will be the cost of acquisition as such. In any other case, the cost of acquisition will be nil. If a depreciation is being already claimed on that goodwill, the cost of acquisition shall be reduced accordingly. Fine. Now going forward, a new provision. This is a new provision which is being taken up in 80G5 clause 8 and clause 9, wherein from 1/4/2021 it is being applicable, wherein the NGOs and trust have to file Form 10A in order to have those who are having 80G certificates. Now this section says complete procedures of how to file, where to file, and when to file the application as such. Further, every institution having 80G certificate has to furnish an electronic statement in the manner prescribed over here. Now, the Form 10A and Form 10B has to be filed. As of now, the due date is of 30/6/2021. That is within the 3 months of 1st April 2021. And we have to wait and see in this challenging COVID pandemic how the government extends further this due date, and the registration which is being taken up or the submission of this form which is being taken up online will be valid for 5 years as such. Right? Now going forward for rental housing project of 80 IBA, new section, subsection 1A inserted in assessee with respect to gross total income, wherein which includes the income derived from the business for developing building rental housing project. The deduction shall be allowed to 100% of the income of such project as such. Now, this section provides a deduction of 100%. Provided the assessee's gross total income is being included with that income, and it is being the project which is being approved on or before 31/3/2021. Fine. So that is very important. Now this 31/3/21 is being further extended to 31/3/22. Now going forward for income escaping assessment, section 147, which been a complete revamp for the assessment as such. Now overhauling of complete section of section 147, including 48, 149, 151, and a new section of 148 is being inserted as such. Earlier section 147, these are all which is being given in the section as such. Earlier section 147 starts with, if an assessing officer has a reason to believe that any income chargeable to tax has escaped the assessment from any assessment year. Now, after amendment, if any income chargeable to tax in case of an assessee has escaped the income. Fine. So the difference is, earlier the assessing officer has reason to believe. Now the income chargeable to tax is being escaped the income. Fine. So going forward with the same section 147, earlier provision, assessee or assess or reassess such income and also any other income chargeable to tax which has escaped assessment and which come to his notice subsequently in the course of proceeding. So in the course of proceeding also, when an AO comes to notice of any income which is being escaped, then the assessment and the reassessment can be taken up. Now, assess or reassess income or recompute the loss or the depreciation allowance or any other allowance on deduction of the such assessment here. So the difference you can see that, and new explanation to this which is being inserted further. First provision says that no notice under this section shall be issued unless AO has obtained the prior approval of specific authority. So the specific authority is being newly introduced, and the section is also given who is the specific authority as such. Earlier, no notice shall be issued under this section 148 by an assessing officer unless the principal chief commissioner, or the principal commissioner or the commissioner is satisfied on the reasons recorded by the assessing officer. Now everything put together, it is being a prior approval of specific authority. Going forward, what does the specific authority means which is being given in the section as such? If 3 or less than 3 years have been elapsed, principal commissioner or principal director or commissioner or director, if more than 3 years have been elapsed, principal commissioner or principal director general, or where there no chief commissioner, principal chief commissioner or principal director, chief commissioner or the director general. So this has been specifically given in this section who shall be the specific authority. So new section 148A, which is being introduced in Finance Act 2021, the obligation is on the part of AO that AO shall, before issuing the notice, conduct an inquiry, if required, with the prior approval of specific authority, provide an opportunity of being heard to the assessee with the prior approval of specific authority. So to conduct an inquiry and to provide an opportunity, prior approval of specific authority has to be obtained. Now the time limit for notice under section 149, which is being revamped and which is being reduced, after 3 years but not more than 10 years, AO has in his possession books of accounts and other documents or other evidences which reveals the income chargeable to tax as escaped assessment exceeding 50 lakh rupees or more. If it is within the 3 years, no threshold limit and no conditions to be satisfied for having the time limit as such. Now, with this, we have been finishing the amendments in Finance Act 21. Now, going forward with the changes in the income tax forms for assessment year 21, 22, there are so many changes which is being taken place. Till half an hour more, I shall quickly run through all the slides for this particular thing. ITR 1 and ITR 4 cannot be filed in the case of deferment of taxes on ESOPs, fine. So in case of ESOPs, in Finance Act 2020 has allowed the deferment of payment of deduction in case of tax deduction in case of ESOPs allotted by an eligible startup. That is, the tax is required to be deducted towards the ESOPs within the 14 days from the earliest of the following period after the expiry of 48 months from the end of the assessment year relevant to the financial year in which the ESOPs are being allotted from the date of assessee ceases to an employee of an organization or from the date of sale of shares allotted to ESOPs. Now, consequently, Rule 12 has been amended to provide that an assessee in whose payment or deduction of tax in respect of such ESOPs has been deferred shall not be eligible to file ITR 1 and ITR 4, which is being taken up. Now, corresponding changes have been made in ITR 4 and ITR 1, and we have to follow that in filing ITR 1 and ITR 4. ITR 1 cannot be filed in case of tax has been deducted under section 194N. So this is a new section 194N, which is being introduced in Finance Act 2020, wherein section 194N provides that every banking company, banking institution, cooperative banking, and post office responsible for the payment of cash to a person from one or more accounts maintained by him in the same bank shall require to deduct under this provision. Taxes under this provision shall be deducted for the withdrawal during the year when it exceeds 20 lakhs in case of non-filers and in 1 crore in case of others. Rule 12 of the income tax rules has been amended to restrict an assessee in whose tax has been deducted under this provision from furnishing the ITR 1. So for the individuals for whom 194N is applicable, and in 26 AS automatically this TDS will come. For those persons, ITR 1 cannot be filed as such. So consequent changes have been made in ITR 1 also. No options to carry forward for TDS deducted under section 194N, as we all know under section 199 read with 37B. For any credit given for a tax which is being related to an income, it shall not be carried forward and it will be taken in that assessment year itself. For instance, if that TDS is being with respect to the income which is being spread over for 2 or more years, then proportionately the income will be taken. Now in case of 194N, TDS under this 94N cannot be directly linked to the relevant income of an assessee because it is towards the cash payment and the cash withdrawal. Hence, any credit which is being given under this section cannot be carried forward and it has to be availed in that particular assessment year itself. TDS under shall not be carried forward, and with respect to this, from ITR 2 to ITR 7, the restriction to carry forward under section 194N is being incorporated. Fine. Now going forward, changes to be made in taxability of dividend income, which is being debate from Finance Act 20 and in Finance Act 21 also. So Finance Act 2020 has been taken away the taxation of dividends in the hands of the recipient of shareholders. Instead, it is being taxable in the hands of a person who are been receiving the TDS. Now, dividend distribution tax is not also applicable from 1/4/2020. Hence, section 1034, 1035, 1150, 115R and 115BBDA have been amended to bring the suitable changes. The new ITR forms which is being notified for assessment year 21-22 have been amended to incorporate all these changes in all the sections which is being clearly mentioned. Now going forward with Schedule OS, that is income from other sources. So Schedule OS, the information of the residuary income which will be disclosed in Schedule OS of ITR forms. So dividend income earned by a person is taxable as income from other sources under section 56(2)(1). Up to the assessment year 2021, Schedule OS was required to the disclosure of dividend income only with respect to the which is taxable, so not exempted, only have to be reported. Now, in new ITR forms, Schedule OS has been amended to include disclosure of all the dividend income, both taxable and non-taxable as such. Now, deduction of expenses from dividend income, so income from other sources, well, the expenses which could be deducted from the dividend income. Section 57 allows a taxpayer to claim the deduction with respect to the interest expenses subject to a threshold limit for earning a dividend income as such. A new row has been inserted in Schedule OS to allow the deduction towards the interest in expenses. However, this deduction is available only if the dividend income is being taxable under under Schedule OS. Fine. Now going forward for dividend income chargeable to tax at special rates. Prior to assessment year 21-22, companies were liable to pay dividend distribution tax, and shareholders were liable to pay dividend under section 115BBDA only when the amount exceeds 10 lakhs during the year. Now, the Finance Act 20 has abolished dividend distribution tax. Consequently, the provision of section 115BBDA are not applicable on dividends distributed, declared, or paid by the companies on or after 1/4/2020. Right? Now, the reference to the section of 115BBDA, which has been removed from Schedule OS in the new ITR forms, because now all the dividends is to be taxable in the hands of the recipient. So this section 115BBDA has been removed from Schedule OS in the new ITR forms as such. Dividend income of non-resident unit holders. So when an SPV, special purpose vehicle, distribute dividends to a company or a business trust as such, such dividend is being further distributed by business trust to its unit holders. Fine. So there are two things to be noted over here. Special purpose vehicle distributes dividend to the business trust, and business trust distribute that dividend to the unit holders. If the business trust distribute the dividend received from SPV to the unit holders, then the same shall be exempt from tax in the hands of unit holders if the SPV who is distributing has not exercised the option of concessional rate as prescribed under 115BBA. If the SPV has been availed the option to pay the tax at the concessional rate, then the exemption is not being exempted in the hands of the unit holder. Now, this has been brought in as a new row under Schedule OS under any other income chargeable at a special rate. So this amendment is being brought in the ITR forms as such. Schedule SI in the returns special income, wherein Schedule SI contains the list of income which are being chargeable to tax, that is long-term capital gain or winning from lotteries or games as such, wherein special income which is being treated. And since section 115BBDA has become redundant, corresponding changes is also being made in Schedule SI. Now, Schedule EI, exempt income, going forward with Schedule EI of the ITR forms provides for the disclosure of incomes which are being exempt from tax, right? Now, as dividend income not exceeding 10 lakhs was previously exempt from tax under section 1034, the taxpayer has to report such income in Schedule EI till the previous year. Now, the entire dividend, both taxable and the exempted, which has to be reported, and hence the reference of dividend income from domestic companies exceeding 10 lakh has been removed from Schedule AI. Since the section is being taken off, 1034 is become redundant, that has been removed in Schedule EI as such. Going forward towards the pass-through income. Now, what is a pass-through income as such? Pass-through income status is a business structure through which the tax is eliminated at pool level and it is being levied at the investor level, meaning where it is being taxed at the level where an investor invests in the business trust or a company. The company earns a profit or a dividend as such, but it is not being taxed at the pool level. On the other hand, it is being taxed at the investor level. This is a concept of pass-through status. So same thing is being explained over here. Schedule PTI seeks the details of pass-through income from business trust or investment fund as per section 115 UA and section 115 UB. Since there is a pass-through status for the investment made under the business trust or the company, this schedule PTI is being taken up with the details of pass-through income. Now going forward for the other amendments, section 115 UA, section 115 UB deals with the taxation of income of business trust, investment funds and their unit holders, allows the pass-through income of certain nature from business trust investment funds to its unit holders. Certain incomes, that is, apart from that pass-through income, certain income, interest, rental income is taxable in the hands of unit holders and not in the hands of trust. So to bring that adjustment over here, that income could be house property income, capital gain, or dividends which is being as per section 1150 or other exempt income. So apart from pass-through income, these income also which is being generated by the business trust or the investment fund will also be taken up in the hands of the unit holders as such. Going forward, as a dividend distribution tax has been abolished, reference to 1150 has been removed from the dividend income which is being passed to the unit holders. Such amendment is being made in the pass-through income of PTI, schedule PTI as such. Now going forward for breakup of dividend income. So in ITR 1, quarterly dividend breakup was being given, but it was not being given under ITR 1 as such. So what is the benefit of giving this quarterly breakup of dividend income? In order to compute the interest which is being taken up under 234C for the default payment of advance tax liability, to provide similar relief for the persons who have been filing ITR 1, this quarterly breakup has been brought in ITR 1 also. So that amendment is being made in ITR 1. Schedule DDT removed from ITR 6 as dividend distribution tax has become redundant and abolished with effect from 1/4/2020. Schedule DDT has been removed in ITR 6 form. Now going towards increase in the threshold limit of tax audit or ITR 3 and 6. So as per the provision, we all know very well if the gross turnover or the receipt exceeds a specified limit which is being given as 1 crore, and in Finance Act 20 it was being extended from 1 crore to 5 crore. If the cash receipts and the cash payment does not exceed 5% of aggregate of amount cash payment, including the amount incurred for expenditure, does not exceed. So how it is being taken up in ITR 3 and ITR 6? Now it is being taken up to 5 crores to 10 crores. Previous ITR forms required the assessee to furnish whether during the year total sales turnover, gross receipt of the business exceeds 1 crore but does not exceed 5 crore. So this checkbox was there, and now necessary amendments have been brought in the ITR forms as notified for assessment year 21, 21, 22 to enhance the limit. That is from 5 crores to 10 crores is being brought in the new ITR as such. Adjustment of unabsorbed depreciation if an assessee has opted section 115 BAC or 115 BAD from ITR 3 and ITR 5, the adjustment has been taken up. So this two new section, which is with respect to the new tax regime, which was being introduced in Finance Act 2020, which is a special regime 115B AC for individual and HUF, 115 BAD for cooperative society, and of certain conditions, these two new tax regime can be availed. Fine. So what one such condition is, the assessee cannot claim the additional depreciation as such. Further, any unabsorbed depreciation relating to such additional depreciation shall be deemed to be given full effect and no further deductions will be allowed in the subsequent year. So any unabsorbed depreciation till time, if it is been there, it has to be taken up to the full effect, and in the further years, it should not be taken up when those assessees are going for the new regime under 115 BAC and 115 BAD as such. Now, however, these two sections, with the introduction of this, the 115 BAC and 115 BAD, wherein the assessees are allowed to increase the written down value of block of asset, and necessary adjustment has been made in the ITR with respect to that. So in 3 and 5, in schedule DPM for the assessment year 21-22 is being made up, and in schedule UD for unabsorbed depreciation and allowance under 35(4) has also been amended. For any unabsorbed depreciation have been put addition for the increase of written down value in the respective block of assets. Now, adjustment towards 115B AA, this is with respect to the companies who are being going forward for the new tax regime. For them also the same conditions is being taken up. That is, they cannot claim deduction of additional depreciation and the unabsorbed depreciation. So same will be taken up. Then adjustment was being required to WDV as on 1/4/2019 only. ITR 6 is being notified for assessment year 2021-22 has been removed the respective columns in which such adjustments are required to be made. Now going forward with introduction of 80M, which is being taken up in Finance Act 2020, wherein the deduction towards a domestic company for the amount received as dividend from another domestic company and a foreign company as such. So this deduction will be allowed only if the company further distributes the dividend to the shareholders. And now this distribution has to be taken up before 1 month from the due date of furnishing of the returns, and ITR forms of the assessment year 21-22 have been accordingly modified to include this particular section of 80M under schedule 6A so as to enable the company to claim such deduction under 80M. So ITR 6, this is only with respect to the company, and hence the ITR 6 is being amended so far. Deletion of schedule DI, this is with respect to the making the investment and deposits. Fine. So due to the COVID pandemic situation for the financial year 19-20, we had an amendment with respect to the make an investments in deposits or in any other payments to be made for LICs or any other payments under Chapter 6A or Section 10 AA, and the exemption to be claimed from 54 to 54 GB till 36/2020. It was further extended to 31/7, and in case of Section 54 to 54 GB, it was extended to 39/2020. Now, with respect to this extension, it is only for the assessment year 19 and 20, and the taxpayers are not allowed to claim the deductions which has been claimed already. To bring in clarification to that, Schedule DI, detail of investment deposits payment, has been removed for the particular for assessment year 21 and 22. Fine. So it has been further clarified. Once an exemption which is being claimed in the last year cannot be claimed for the assessment year 2021. So amendment has been made to reference of Schedule DI as such. Excess of option of prescribed under 115 BSc ITR 1 to 4, wherein the individual is going for the new regime as such. So Part A, in Part A general information, the assessee has to choose whether going towards a new regime or taking up the old regime, and they have to file a form 10IE in respect of individuals and HUF, and correspondingly now in general information, after filing that form 10IE, acknowledgement number has to be given when they have been choosing the new assessment, new regime as such. Going forward, the same procedure for 115 BAD in ITR 5 towards the cooperative society who have been opting for alternative taxes. They have to file on or before the due date form 10IF. And hence in Part A general information, they have to give the details whether opting for that particular section and the acknowledgement number and the option of exercising the new regime. So in Part A general information, the amendment has been made. Clause-wise disclosure of interest taxable under Section 115A read with 194 LZ. Here, the disclosure to be taken up in ITR 2, 3, 5, 6, and 7. 115A specifies the tax rate on the specified income in the hands of non-resident assessee in for dividend, interest, royalty. In respect of interest income referred to 194 LZ, I'll tell you in a brief. Fine. So 94 LZ says that 5% tax will be deducted at source, wherein the interest is payable in respect of money borrowed from sources outside India by issue of long-term bonds and rupee-dominated bonds. 4% deductions will be taken up. So there was two parity, that is 5% and 4%, and this to bring in the clarification towards this, two different rates. ITR forms has been amended to have a separate disclosures under Section 194 LZ of 5% and 4% as such. Safe harbor limit prescribed under 50C for ITR 2, 3, 5, and 6. What does 50C says? A special provision for determining the full value consideration in case of transfer of land and building or both, as we all very well know. There was a safe harbor of 5% of difference between the stamp duty value of that particular state and the sale consideration received. Now, this safe harbor limit has been increased from 5% to 10%. That is still 110% the difference, the stamp duty value can be taken up. So consequently, changes in ITR 2, 3, 5, and 6 have been amended to bring in the effect of the change in the safe harbor limit in the Finance Act 2020 as such. Going forward, due date for the date for cash donation in case of deduction under 80 GGA, ITR 2, 5, and 6. So Section 80 GGA provides a deduction for donation made by the assessee who is not earning income under the heads profits and gains, no deductions will be allowed if the cash donation is in excess of rupees 2,000. So ITR 2, 5 and 6 containing 80 GGA requires a separate reporting of donations, fine. So this additional disclosures have to be made and respective changes is being made in the ITR forms of 2, 5 and 6 for the assessment year 21 and 22. Going forward, for reference of Form 16D, which is being inserted in Schedule of Tax Payments, that is for ITR 3 to ITR 7. So 194M provides every individual and HUF who are not required to direct tax under 94C, 94H and 94J. That means when they are not under the tax audit, even then they have more payments to a contractors or commission agent. In that case, they are being eligible to have direct the tax at 5%, and they have to issue Form 16D as such. So ITR forms requires the details of tax deducted as per the certificate issued by the director. So for this assessment year 21-22, ITR forms is being incorporated to have a reference of Form 16D as such, right? Undertaking not eligible for deductions removed from 80IB, that is 3, 5 and 6. So assessee deriving profit from specified business are being eligible for 80IB. So I'll skip off who are all the specified business, as we all know very well. So the sunset provision also I'll skip off. Now, Schedule IB has been amended to remove the appropriate rows, allowing the deduction under the obsolete subsections, right? So, the undertakings which are not being eligible for deductions under 80IB, that rows has been removed in ITR 3, 5 and 6 as such. No separate reporting of income for life insurance business, so ITR 5 and 6. So earlier, the separate disclosure of insurance income from insurance business was being necessary with respect to net profit under Section 115B, additions in accordance with Section 30 to 43B, deduction in accordance with 30 and 43B, income from life insurance under 115B. Now, no such disclosure reporting, separate reporting is not required. So ITR forms notified for assessment year 21-22 has removed such separate reporting requiring the respect of incomes under the life insurance business in Schedule BP. I'll take 10 more minutes to finish off this. Nature of security to be furnished in Schedule 112A and Schedule 11AD, ITR 2, 3, 5 and 6 as such, fine. So in case where long-term capital gains are arising from transfer of securities, being equity shares, units of equity-oriented mutual funds, wherein the security transaction tax is being applicable, a provision of 115 AD 1B clause 3 provides a long-term capital gain arising from the above mentioned securities in the hands of FPI. Hence, a new schedule has been taken up. ITR forms notified for the assessment year have inserted new column in both the schedules requiring the assessee to provide the nature of securities, that is equity shares, units of equity oriented mutual funds and the units of business trust as such. Computation for cost of acquisition, as we have been taken up, will be the cost of acquisition will be higher of the following: actual cost of acquisition, lower of market value of such asset as on 31/1/2018 or full value of consideration of result of transfer. Schedule 112A and 115AD requires the assessee to fill the relevant information regarding the capital gains from the specified authorities. Hence, the information regarding the sale price, fair market value, cost of acquisition of the security has to be ascertained and has to be given in the ITR forms. 5A, which is being required to furnish the tax audit requirement of a spouse as such, fine. So in case the spouse has to furnish the details, even that spouse is a partner in a firm wherein that firm is subject to a tax audit. For them also, it is being extended to 30th November in case of transfer pricing report has to be submitted, or 31st October in case of tax audit to be submitted. So what does 5A say? So 5A requires the confirmation whether the spouse of a partner who is there, wherein the partner apportioned the income to a spouse, since the spouse has been filed the return of income or not. So section 5A is being introduced to know whether the spouse of a partner, wherein the partner apportions the income to a spouse and that spouse income is being subject to a tax audit. In such a case, the ITR forms is being taken up with the amendment that name and PAN of a spouse and income under which the heads of the income, the spouse has to be filed. And in ITR 3, the dates have also been given for the furnishing of the returns by that particular spouse of a partner, fine. Now towards the 54 EZ, I'll just go through with the amendments alone. ITR forms except ITR 5 contain the ceiling of deductions under this section. So earlier, all the ITRs except the ITR 5 had a row for the exemption to be claimed under 54 EZ. Now ITR 5 for the assessment year 21-22 also provides for the deduction under section 54 EC, which shall not exceed 50 lakhs. Nature of business, this is quite interesting under 80P for the producing company in ITR 5. These are all nature of 80P for the cooperative society and other society engaged in the agricultural business and who are being helping the farmers for carrying on the agricultural business. The amendment made over here is ITR forms for assessment year 21-22 has been inserted one column in order to give the business code of the various types of the income for that particular person. So I've been claiming exemption and ITRP, they have to disclose the business code as such. Additional questions with compliance to 192E in ITR 3, 5, and 6. In Part A, general information, there was a column whether you have been opting for transfer pricing or not. If yes, we have to click as and furnish a date of filing. Now it is being amended by inserting a new question as if the assessee was liable to a transfer pricing report under 92E, whether he has actually complied with such requirement or not. After clicking yes, the assessee is required to furnish the date of filing of report. Fine. Now, long-term capital gain, short-term capital gains other than those covered in section 11A cannot be disclosed in schedule PTI, that is pass-through income as such. So reference to the distribution accumulated, I'll just go through the amendment alone. Since adjustment of such accumulated losses was allowed to be made in the assessment year 2021 only in case of accumulated losses by investment fund, the ITR forms is being adjusted for assessment year 21-22 completely is being removed because that losses is only with respect to assessment year 20 and 21. Hence the ITR forms, all these have been removed. And bifurcate of losses, we have pass-through losses as pass-through income and normal losses. Earlier, the bifurcation has to be given, and now the bifurcation is not necessary as per the ITR utilities. Hence, in order to have at par with ITR utilities and ITR forms. This amendment has been come up, and in forms of assessment year 21 and 22, this bifurcation has been removed, and now consolidation of all the losses is being given a fine. So for last 10 slides I have been rushed through due to lack of time, since I want to finish in time of 2:30, since the other speaker for the TDS, she has been waiting for her time. So thank you very much for being patiently listening. I have shared my insights towards the Finance Act 21 and the ITR changes. We have to wait and see as the form comes, and now recently JSON utilities have been introduced for the filing of returns. So at present only I think ITR 1 and 3 has come up, and we have to wait and see how these changes have been incorporated. So wish you all the best for happy filing for this current year amidst the bad time as we are been going on. This type of courses and this type of meetings are being a positive in nature, bringing an inspiration to all of us to take up our profession little ahead. Thank you, everyone. Thank you, everyone of all the organizers as such for giving me an opportunity to share my knowledge. Thank you. Thanks a lot.
Thank you, ma'am. We have a question in chat box.
Yeah,
I
one
just
minute,
read
yeah.
it for you.
Yes, ma'am.
It's RTGS and bank transfer will be considered non-cash or cash transactions.
Yeah, as of the section says that it will be considered as a cash payment only, fine. So the section says that when it comes to the ITR, we have to wait and see how it is being taken up.
Okay, ma'am. And if you can share your email ID, there's a request from one of the member also. So
Yeah,
we can
definitely
connect with you.
Yeah, definitely. I'll put in the chat box.
Sure, ma'am.
Yeah.
I think there are no more questions.
I
Yes,
shall
please.
stop sharing my screen now.
Absolutely, ma'am. That's fine.
Yeah. Now in this chat, I'll share my email ID as such.
Sure, ma'am.
And number 9942081168. So I have shared my mail ID and my number as such.
Okay,
Thank you
everybody
so
take
much.
note
Yeah.
of it. And I would like to say something, ma'am, that
Yes.
it's an inspiration for all of us, that the time when we are coming, we are planning for a comeback after raising our kids and taking a big, gap of 4 years, 5 years, 10 years, and you are a big inspiration for us, that you are joining at the time when we are planning for a comeback. So it's a big thing for us, and it's big inspiration for mothers and CA like us. So on behalf of Ahmedabad branch, I would like to take an opportunity to thank you that you took us to a beautiful and quick journey to amendments in Finance Act 21-22 and changes in ITR form for assessment year 21-22 in a crisp manner. That was very fresh and up. We have got, it was very nice. So thank you so much, ma'am.
Thank you.
And
Thanks a lot.
we'll plan to have more sessions with you in future time.
Definitely. Sure.
Thank you so much, ma'am.
Yeah.
Thank you, Bosky. Over to our next session for the day. We are having CA Pranali Thakore to throw light and enlighten us all on this beautiful topic of TDS. Pranali, she is a chartered accountant since 2010 and with more than a decade of experience, and she works in direct tax, indirect tax, project finance, also statutory audits, and most importantly, she handles appeals, which is a very difficult task, which most of us, are a little averse to. All the more appreciation to her, because she is the, I guess, only woman who has set it out on her own, and she has built her practice over a period of a decade. So having a nice, learned, hardworking, sincere faculty amongst us. Over to Pranali.
Hello, everyone. Am I audible to everyone?
Yes, yes.
Thank you so much, Hemaban, for such a wonderful introduction of mine. Thank you so much. And first of all, I would like to congratulate the entire team of Women Member Empowerment Committee for curating such a beautiful, wonderful, commendable series. I have just gone through the curriculum of this series, and I can see the topics which have been included, and it shows the efforts and the brainstorming that has been done before floating this series. So kudos to the entire team of Women Member Empowerment Committee. Secondly, I would like to congratulate the Ahmedabad branch entire team for coming every day with each other new initiatives, whether it's medication, it's vaccination, food kit, or Movement 73, any damn thing, but they are making sure that the members of the branch remain connected with the branch in some way or the other. So kudos to the entire branch, and I would simply say Ahmedabad branch rocks. So thank you so much, and I would like to thank C. Harit Dariwarji, chairman of the branch, secretary of the branch, C. Anjali-ben, Hema-ben, and all the coordinators for believing in me and giving me this opportunity to be a speaker for today's session. I hope I come up to your expectations. Thank you so much. I'm very much grateful to making me a part of this wonderful series. Thank you so much. Now, shall I start with my presentation so that we can cover each and everything, right?
Thank you.
So I have been given the topic today for the Finance Act TDS provisions for the Finance Act 21 and its interplay with TDS TCS, right? But since it's a refresher course series, I have not confined myself just to Finance Act 21. I have taken even some sections, some provisions which have been newly introduced in the Finance Act 2019 and 2020, keeping that some women who are thinking of coming back into practice and will be taking up audit in the next few months. So I have included even some sections of 2019 and 2020 so that everyone can get benefited at a larger end, right? So let's start with our presentation. So today, what can you expect from this? So I will not be discussing what is 94C or what is 94H, as we all have done in our academics. So straight away, I'm starting with those main sections which have been introduced in the last 2 or 3 finance acts, right? So first of all, let's start. Everyone is with me? Hello?
Yes, ma'am.
Yes,
Yes. So I'm audible and my screen is also presentable to everyone, right?
Yes, ma'am.
Okay,
we can hear you.
Okay, thank you. Okay. So first 206AA, requirement to furnish permanent account number. So you might be thinking that why I am taking this section. Yes, because in many sections in the next provisions that I will be taking in the next slides, I will be referring to this section. Secondly, it was introduced way back in 2010, but now its importance has increased. Reason being, a new section has been introduced in the Finance Act 21, that is 206AB, for all those who are non-filers of income tax return. So to compare both the sections, we should have a brief view of what is 206AA, right? So what is 206AA? It speaks, say, notwithstanding anything contained in any other provisions of this act, any person entitled to receive any sum or income or amount on which tax is deductible under Chapter 27B shall furnish his PAN to the person responsible for deducting such tax. So every pay is supposed to provide his PAN to the deductor. And if it defaults in furnishing his PAN, then failing which the tax shall be deducted at the higher of the following rates, namely at the rate specified in the relevant provisions of this act, or at the rate or rates in force, or at the rate of 20%. Now, in 94Q, it's an exception that we will take it when we will take that point, right? So what does it say? That, say for example, if we are making a payment under section 94C and the rate is 1%, assuming that pay is an individual. So, and that individual has not furnished his PAN, then what we will do is that 206AA will be applicable instead of the rates specified in the 94C, that is 1%. So at the rate specified 1% or at the rate of 20%. So we all are knowing this, that when someone doesn't furnish a PAN, we used to deduct TDS at 20%, right? This was all we were familiar with. Now the Finance Act 21 has introduced a new section, that is 206AB, higher rate for deduction of tax at source for non-filers of income tax return. This will be effective from 1st July 21, right? So we need to understand who would be the specified person to whom this section will be applicable. So who is liable to deduct TDS? The person paying any sum to the specified person. Amount on which TDS is to be deducted, any amount, sum, income paid or payable or credited to the specified person. So in both the things, you will see that I have emphasis on specified person. So first we need to understand who will be a specified person. The term specified person includes person who satisfies all the following criteria. The person has not filed the income tax return for 2 previous years immediately before the previous year in which the TDS is required to be deducted, and the time limit for furnishing the income tax return under section 139(1) is expired, and the total TDS and TCS is rupees 50,000 or more in each of the 2 previous years. If it's a non-resident person, then he will not be covered under specified person, assuming he is not having a permanent establishment in India. So you all are with me that specified person means who has not filed the income tax return for the 2 previous years, who has and the time limit for the return has also been expired, and the TDS or TCS is more than 50,000 in both of each of the previous years, right? Now the rate of TDS. So where the tax is required to be deducted under this provision, the tax shall be deducted at higher of the following rates. Twice the rate specified in the relevant provision. So if it's 94C, 1% is applicable, then here it will be 2%. Twice the rates or rates in force and or 5%, right? So higher rate is 5%. In 206AA, it was 20%, and here it is 5%. Non-applicability. Section 206AB shall not be applicable if the sum or income or amount on which tax is deductible under any of the following provisions. 92, that is salary. 92A, that is TDS on withdrawal from EPF. 94B, that is winning from lotteries, crossword puzzles. 94BB, that is from winning from race horses. 94LBC, that is TDS on income in respect of investment in securitization trust. And 94N, that is TDS on cash withdrawal, right? These are the exceptions. So the rates as per the provisions will be applicable, and 206AB will not be applicable in that case. Now other aspects. Now 206AB, what is an overriding section? Provisions of section 206AB overrides all other provisions of Income Tax Act. It will apply even if assessee has lower or nil TDS certificate. So here it says that even if you have applied for form lower deduction by filing form number 13, then also it will not be taken into consideration. Or he has filed a declaration under section 197A, that is even if you have filed 15G, 15H, then also it will not be taken into consideration, right? However, this provision will apply only if the tax is otherwise deductible under chapter 27B. So what it means to say for example, Mr. X is a professional and he has not filed his return of income in both the preceding previous years, and today I'm making him a payment of say 25,000. So professional 94J limit is threshold limit is 30,000, right? If it exceeds 30,000, I am supposed to deduct tax. But since I have made a payment of 25,000, his payment doesn't fall under the TDS liability. So if that is the case, then 206AB will not be applicable, right? Even though he has not filed the return. So am I clear with everyone? Hello, everyone is with me?
Yes, absolutely. Yes, ma'am.
Okay. So just keep on saying so that I can say that you are with me or not. I am okay. Let's move on the next slide. So I have given an example here. Let's have a look at the example to get a better clarity of what else it states. Suppose tax is to be deducted for the financial year 22-23 in case of Mr. X, who is a resident in India. Whether he would be treated as specified person under section 206AB in different situation is analyzed as under. Right, so it's a chat. So I have taken a condition that file our return of income for assessment year 2021, assessment year 21-22, TDS 50,000 in both the years. Then Mr. X will be a specified person or not. So the first scenario is that he has filed the returns for both the years. The TDS is also more than 50,000 in both the years. Then will Mr. X be a specified person? No, because ROI has been filed, right? So 206 AB will not be applicable in his case. Second scenario is that he has filed a return for one previous year and not for another. And in both the scenario, TDS is more than 50,000. Then also not, because it is necessary that all the conditions should be simultaneously be fulfilled. That is, ROI should not be filed for both the years and TDS should be more than 50,000. So here, since he has filed a return for 1 year, Mr. X will not be a specified person. Again, third scenario is same. Now, fourth scenario, he has not filed the return of income for both the years, and his TDS in both the previous years is more than 50,000 TDS or TCS. Then in this case, definitely Mr. X is a specified person, and in his case, 206 AB will be applicable wherever TDS is required to be deducted by the deductor, right? So again, it's a case that he has filed a return of income both the years, but TDS is less, then again he will not be a specified person, because all the four conditions, that is both the returns of both the previous years and TDS should be more than 50,000, should be fulfilled. Then and then only Mr. X will be a specified person, and then only 206 AB will be applicable. Okay, if you go, I will just share this PPT so you can check out the other illustrations also, right? Next, comparison between section 206AA and 206AB. Now, applicability. So we all know that 206AA will be applicable when the deductee fails to furnish his PAN, and this 206AB will be applicable when a deductee fails to furnish a return of income for a specified period, that is 2 previous years, right? And the aggregate amount of tax deducted or collected during such specified period exceeds the specified limit, that is 50,000. Now, rate of deduction, rate specified in the relevant provision, rates or rates in force, and 20%. Here, twice the rate or rates in force, and 5%. Section 206AA, it won't be applicable when when a pay is a non-resident or a foreign company, when interest on bonds referred under section 194 LC is made, or specified payments is referred under section 37 BC, that is interest, royalty, fees for technical services, dividend, even it will be included because it has been now, dividend distribution tax has been abolished from 1st April, and payment for transfer of any capital assets. And even though non-residents or the foreign company has not furnished the PAN, then in this scenario, 206AA will not be applicable. And income in respect of investment in category 1 or category 2, IFS is referred under rule 114AB. 206AB, we have already covered that it will not be applicable when TDS on salary, winning from lotteries, winning from horse races, 294N, that is TDS on cash withdrawal. Right? Further, this provision doesn't apply if the non-resident is not having any PE in India, that is not having any permanent establishment in India from where he is doing his business. Now, special tax rates. Now, 5%, normally 206AA, 20% is applicable if you doesn't furnish your PAN. But there is a special tax rate for two specific sections, that is 5% tax rate to apply if the tax is deductible under section 194O. 194O is a TDS by e-commerce operator or to an e-commerce participant. It was introduced in Finance Act 2020. And 194Q, that is TDS on purchase of goods, it has been introduced by the Finance Act 21 this year, right? If tax is deductible under section 192A, then the rate of TDS shall be the maximum marginal rate, right? Now, moving to the next section, I hope you are all okay with my speed. Hello.
Yes, ma'am. Yes.
Okay, done. Now I have taken. Okay, done. Now next section we are taking, that is 94M. This was introduced by the Finance Act 2019. I have taken some major important sections from Finance Act 2019 and 20 also, so that it can be helpful to those who are into break and they can just have a brief idea about it. 94M, when is it applicable? Payment of certain sums by certain individuals or HUF with effect from 1st September 2019. Right? So who will be the deductor? Every individual or HUF who is not required to deduct tax under section 94C, 94H and 94J shall be required to deduct tax at source under this provision. So you all might be knowing that when a deductor is a firm, company or an LLP, then in the very first year of its incorporation, they are supposed to deduct TDS if they make such payments which fall under the liability of TDS. But for individual and HUF, there was a condition that they are supposed to be into audit in the previous year, immediately preceding the year in which such payments are made, then they are supposed to deduct TDS, right? But the Finance Act 2020, to rationalize the provision, last year declared the limit that now all individuals or HUF whose business turnover exceeds 1 crore, or all those professionals whose gross receipts exceeds 50 lakhs will be required to deduct TDS irrespective of whether they are into audit or not, right? This amendment has been brought for the sections 94A interest, C that is for contract, I that is rent, H commission, J that is professional fees, and 2066 that is TCS. So now if your business turnover is 1 crore rupees or a professional fees is exceeding 50 lakh rupees, then irrespective of that whether you are declaring you are into audit or not, you are supposed to deduct TDS. Right. So now this section 94 I am introduced to cover for which type of people. This section covers two criteria of people, that is every individual or HUF whose business turnover is less than rupees 1 crore or whose professional fees is less than 50 lakhs, and they make certain payments which falls under the criteria of TDS, then 94M will come into play. Second, it covers those people who are not into any business or not into profession, but making certain payments for their personal use. Say, for example, you are getting your house renovated and appointing a builder contractor and making certain payments exceeding certain threshold limit mentioned in this section, then even though you are not into any business, you are earning any damn income, even if you are earning exempt income, that is agriculture income, then 94M will come into play and you will have to deduct TDS, right? So am I clear? This section specifically includes those individuals and HUF who are not into, whose business receipts doesn't exceed 1 crore or 50 lakhs, and even they are making payments for their personal use. Right? Who will be a deductee? The tax is required to be deducted under this provision only if sum is payable to a person who is resident in India, right? So if it's a non-resident, then section 195 will be applicable. That is specifically meant for non-residents, that we all know. Type of payment. So what type of payments are covered? Tax shall be deducted under this provision in respect of following: any sum paid or payable in pursuance of a contract or a subcontract for carrying out any work, including supply of labor for carrying out any work, that is 94C, any sum paid or payable by way of commission, that is 94H, and any sum paid or payable by way of fee for professional services, that is 94J. So when you are making a payment for 94C contract, 94H that is commission, and 94J that is professional fees, then 94M will come into play. Rate of TDS 5%. Tax shall be deducted at the flat rate of 5%. So there will not be any health and education cess or surcharge will be applicable, right? Only flat 5%. Now, as we discussed, I told you that I will be referring section 206AA and 206AB in lot many provisions. So that why I took the section first of all, so that we can have a easy reference to it. So now if PAN not furnished, you all know 206AA will be applicable. So rate will be 20%. If return not furnished for specified period, then you all know 206AB, which has been introduced and effective from 1st July 21 will come into play. Now there might be a case that where a person has not furnished the PAN and even not filed the return, then it is obvious that 206AA and 206AB both are applicable. Then in that case, higher of the rate will be applicable, right? So for example, we assume here that, say for example 94J, we are making certain payment to a professional and he has not furnished his PAN. So as per 206AA, it will be 20%, right? 206AB, it will be what it says, twice the rate in force, so 10 into 2, 20%, or 5%. So higher will, both the cases it comes 20%, so 20% will be applicable. Right? If we take 1% contract, then 1% in the 206AA, in that 20% will come. In 206AB, twice the rate of 1% will be 2%, then and 5%. So in that 5%, so 5% or 20%, then again 20% 206AA will be applicable. Right? So higher of the rate of 206AA or 206AB will be applicable. Now, time of deduction, obviously it's a normal provision of our TDS, that is at the time of payment or credit, whichever is earlier. Threshold limit. Now, tax is required to be deducted only if the payment exceeds 50 lakhs during the financial year. So if you are appointing a contractor and making a payment of 40 lakhs, then 94M will not be applicable, right? No requirement of 10. Now, individuals or HUF who has to deduct tax can pay the tax to the government by quoting his or her PAN, not required to get a tax deduction number for TDS. 26 QD is to be filed. So if you all might remember that earlier in 2017 also, 2013, 194 IA was introduced, TDS on immovable property, right? Wherein the purchaser was supposed to deduct TDS of seller if the sale deed if the sale consideration exceeds rupees 50 lakhs at the rate of 1%. There also individuals were covered. So at that time also the government had come with a provision that every individual is not supposed to apply for the 10 for deducting the TDS of the seller. We used to file form 26 QB, and from that the challan was generated and we used to pay, and it gets reflected in 26 AS. The same concept, same provision has been made here, but only instead of 26 QB, here it is 26 QD, right? Exemption: when you are making a payment to central government, RBI, mutual fund, or any corporation under the Center Act, which is then you are not required to make payment, as they are exempt from paying the tax. Right now, we are moving to the next session. That is 94N, payment of certain amounts in cash. Again, this was introduced by the Finance Act 2019, made effective from 1st October 2019. Now, what does it include? Who will be the deductor? Every banking company, cooperative bank, or a post office, right? Deducting. Tax is required to be deducted in all the cases, whether the deductee is a resident or a non-resident, right? You are supposed to, so here status of deductee can be a resident or a non-resident, and the deductor is a bank or a cooperative bank or a post office. Rate of TDS. Now here the two types of rates will be applicable. Situation 1, if no default is made in filing of return. So here the actual rate is 2%, right? No surcharge and health and education if payment is to a resident person. And 20688, 20% if a person has not furnished his PAN. We are all clear with it that if there is no default in filing of return, then rate of 2% will be applicable. Now situation 2, if a person defaults in filing of return. If a person has not filed a return of income for all the 3 assessment years immediately preceding the previous year. Now we will realize that in 206 AB, they have excluded 94N, right? If you all remember. The reason being, there was for applicability of 206 AB, there is a requirement of 2 years of filing of return. Here 94N specifically states that they require 3 years of filing of return. So they have excluded 94N from its scope. Right? So when TDS comes under 94N, then you are supposed your 3 years of return should be filed. If a person has not filed the return of income for all the 3 assessment years immediately preceding the previous year in which the cash is withdrawn, and the due date for filing the return under section 139(1) has expired, the tax shall be deducted at the rate specified. Up to 20 lakhs, there will be no tax, even if you are not filed your return of income. From 20 lakhs to 1 crore, it will be 2%, and from more than from 1 crore to any limit, it will be 5%, right? Now I have taken an illustration so that we can have a clear view about it. Mr. X withdraws the following sum in cash during the financial year 21-22 as follows: 1st August 10 lakhs, 15th September 35 lakhs, 17th November 25 lakhs, 28th January 45 lakhs, and 16th March 30 lakhs. Now he has not furnished his return of income for the previous year 17-18, 18-19, and 19-20, and the due date of filing the return has already expired. Now in this case, how the TDS will be applicable, we need to check. Since Mr. X has not filed the return of income for the 3 assessment years immediately preceding the previous year in which the cash is withdrawn, and the due date for filing of return under section 139 has expired, the tax shall be deducted as follows. 1st August 10 lakhs you will be withdrawing. Bank will not deduct any TDS because till 20 lakhs it is exempt, right? Even if you have not filed your income tax return. Now we are withdrawing another 35 lakhs. So cumulatively it will be 45 lakhs. But 20 lakhs is a threshold limit. Exceeding 20 lakhs, 2% will be applicable. So 45 minus 2 lakhs, that is 25 lakhs, 2%, 50,000. Now we are withdrawing another 25 lakhs. So on the straight away 25 lakhs, 2%, it will be 50,000. Now another 45 lakhs. Now it crosses cumulatively 1 crore. So here 2 slabs will be applicable. Up to 1 crore, the bank, and any amount exceeding 1 crore, it will be deducting tax at 5%, right? So 1,35,000. And the last, that is 16th March, another 30 lakhs has been withdrawn. So there 5% will be applicable. How to check the return filing status? Now the government has provided a utility to the bank, and it's an internal process how they can check the bulk, how it is proceeding, right? In which will be available to the scheduled commercial banks to check the IT return filing status. And the same way in 206 AB also, this type of utility will be provided to the banks for checking the status of the payee. Time of deduction, obviously at the time of payment. Exemption. Now, provided that nothing contained in this subsection shall apply to any payment made to the government, any banking company or a cooperative society engaged in the business of banking or a post office, any business correspondent of a banking company or a cooperative bank, any white label automated teller machine operator, or any such other person or class of person. So you might be aware that a white label automated teller machine operator is covered, right? Then after CBDT, central government by notification has exempted another two persons, that is cash replenishment agencies and franchise agents of white label automated teller machine operator. So what is white teller machine operator? I would just like to, there are two types of ATMs, one that is owned by the banks and another is by the not owned by the non-bankers but authorized by the RBI, right? So those who are owned by the non-bankers and authorized by the RBI are known as white teller machine operators. Right now, operators were originally exempted, but by issuing a notification, government also exempted their agencies, subject to the operators have furnished a certificate every month to a banking bank certifying that the bank account of CRAs and the franchise agents have been examined and the amounts being withdrawn from their bank accounts have been reconciled with the amount cash deposited in the ATMs. Then in that case, even they withdraw more than ₹1 crore for replenishing the cash in the ATM, then 94N will not be applicable. Another exemption was given to the APM, the traders and commission agents of the APMC, because they need to pay the cash to the farmers. So in that case, they need to make cash withdrawals. So once they provide the certificate and the declaration to the bank regarding that they are the registered under the particular agriculture produce market and the PAN quoted is correct, and then the even commission agents or trader registered with APMC will be exempt from applicability of section 194N. Right?
Excuse me.
Huh?
Ma'am, this provision is explicitly for the cash withdrawal only. If I give a check to someone for 20 lakhs or 50 lakhs, so this doesn't come in the picture, right? Only cash withdrawal.
It is from the amount that you are withdrawing from your own bank account, right?
Yeah, right. But if I'm taking some, a property and I'm giving some check to, so instead of, withdrawing the cash and giving to them,
you are supposed to, that is now you can't purchase a property exceeding you can't pay someone with, you have to, suppose you are taking a property, then bank you are supposed to make a payment on by account pay check only, right?
Yeah. So this provision will not.
So no. So you can't give a check now without, you can't give a bearer check for buying a property. That is now done away with, right?
Right. Okay.
Now payment of certain now most important, another payment of certain sums by e-commerce operator to e-commerce participant with effect from now. This has been introduced last year, but I have included it so because in the very few months we will be taking the audit, so we need to check if somebody having an e-commerce operator as their client, right? So effective from 1st October 2020. Deductor, every e-commerce operator, right here, every e-commerce operator facilitating the sale of goods or provision of services of an e-commerce participant, right? Facilitating the sale of goods or provision of services of an e-commerce participant through its digital or electronic facility or platform is required to deduct tax at source, right? Who will be a deductee? Here the e-commerce participant is supposed to be a resident person. Now rate of TDS, the tax shall be deducted at the flat rate of 1%. If PAN not furnished, then 206AA will be applicable, that is 20% normally. But for the Finance Act 2020 has given a substitute as exception to it, that for 94O, instead of 20%, 5% will be applicable if a payee doesn't, that is a participant doesn't furnish his PAN. If return not furnished, then 206AB will be applicable from 1st July 21. And in case of both sections are applicable, then higher rate will be applicable. Now time of deduction. The tax is to be deducted at the time of payment or at the time of credit of sum, whichever is earlier. Amount on which tax is to be deducted. So this is most important point. Now on which amount the e-commerce operator is supposed to deduct tax of e-commerce participant. Tax is required to be deducted from the gross amount of sale of goods or services or both facilitated by the e-commerce operator. Gross amount is equal to total sale made by the participant through the platform owned by the e-commerce operator less the discount offered by the e-commerce operator, but before reducing the promotional discount given by the e-commerce operator and before deducting any commission charged by the e-commerce operator. So what does it mean? we all buy goods nowadays online. So you might have observed that sometimes we get a discount straight away from the vendor who is registered with that e-commerce operator, right? And sometimes as per their agreements, the e-commerce operators like Swiggy, Zomato, or Amazon is like that. They normally, to boost up the sales of different vendors, of their vendors who have been registered with them, they themselves also provide some discounts. So while calculating the gross amount for deduction of tax, only the discount straight away provided by the vendor himself will be taken into consideration, but the additional promotional discount given by the operator to the end user will not be taken into consideration. Even the operator charges to the participant for the services that they provide, that will also be not be reduced, right? So say for example, X.com, a resident e-commerce operator, facilitates the sale of goods by the Indian traders in India. The transaction done during the previous year through its platforms are as under. MRP 2000 lakhs of sales has been facilitated by the e-commerce operator of one of its participant. Now 10% discount offered by e-commerce participant, it will amount to 200 lakhs. 10% discount offered by e-commerce operator, 200. 10% commission has been charged by the e-commerce operator, 180. So in this case, gross amount of sale is A minus B, right? So 2000 minus B, that is 200. That's so 1 crore 80 lakhs. And xyz.com is required to deduct tax at the rate 1% of 1 crore 80 lakhs. It will amount to 1,80,000. So I think this point is definitely clear at your end now. Explanation. Now sometimes we don't know, whenever we make payment, sometimes we end up making payment to payment gateways, then they proceed, then they make payment to the participant or the operator. Sometimes our payment directly goes to the operator, sometimes our payment directly goes to the participant, right? So that is not in our end, it is as per the agreement that they have entered into. So even when any payment directly made by the end user to the participant, the same will be considered as if the payment is made by the operator to the participant for computing the gross amount for deduction of tax, right? Now threshold limit, there is no threshold limit. From a very single rupee of sales facilitated by e-commerce operator, the TDS is to be deducted by the e-commerce operator to the e-commerce participant. Now exception, however, there is an exception. No tax is required to be deducted if the following conditions are fulfilled. E-commerce participant is an individual or a HUF. Gross amount of sale or goods services does not exceed 5 lakhs, and an e-commerce participant has furnished his PAN or Aadhaar to the e-commerce. If 3 conditions are fulfilled, then and then only the e-commerce operator will not deduct TDS of an e-commerce participant. Otherwise, in respect of any other payee, there is no threshold limit. From a single rupee, the TDS is to be deducted. No deduction under any other provision, right? Where the tax has been deducted under this provision, or where no tax is required to be deducted because of the above exemption given to the individual specially, then no tax is required to be deducted under any other provisions of the Act. So once 194O becomes applicable, right, then even the payment gateway doesn't have to deduct TDS on the same transaction, right? Because this section overrides that once it is applicable, then other sections will not be applicable. However, if an e-commerce operator has provided certain services like allowing the advertisements, giving slots for advertisements or promotional, then they are charging certain amount from the e-commerce participant. Then in that case, participant will be deducting the tax of the e-commerce operator if they are required, right? 94C or J. Now exceptions, transactions carried out through record. So that when this provision was introduced last year, there were many confusions. So CBDT came with certain guidelines that if the transactions carried out through recognized stock exchange in respect of shares or securities, then the same will not be applicable. 94O will not be applicable. Reason being, there is not the buyer and the seller. There is no one-to-one contract between the buyer and the seller. Then the payment gateway will not. Another exception is the payment gateway will not be required to deduct TTS if the tax has been deducted by the e-commerce operator under this provision on the same transaction. Just excuse me for a minute. The payment gateway will not be required to deduct tax if the tax has been deducted by the e-commerce operator under this provision on the same transaction, right? So for this, they have to take a certificate from the e-commerce operator that they have deducted the TDS, so now they will not be liable. But if in case e-commerce operator is not deducted, then the payment gateway will be liable. Now, insurance agents and insurance aggregators. So normally in the subsequent years after the first year, if the insurance agents or the aggregators doesn't have any role between the insurance company and the buyer of the insurance policy, then also 194(o) will not be applicable in that case, right? Now, another concept of equalization levy. Why I have included here, because equalization levy some might be aware of it, some might not be, but there were major changes brought into equalization levy last year by the Finance Act 2020. Originally, equalization levy concept was introduced by the Finance Act 2016, and it was limited to only specified services only, right? So let us have a look at it. What is equalization levy? This is a tax leviable on consideration received or receivable, right? Tax leviable on a consideration received or receivable by a non-resident for any specified services. What can be a specified services, such as online advertising, any provision for digital advertising space, or any other facility or service for online advertising at the rate 6% from a person resident in India and carrying on business or profession. So carrying on business or profession was very much required, and a person should be a resident in India and a non-resident having a permanent establishment in India. So for giving you an example, if you are taking any service from Facebook for advertisement of your business and you are into business, then, and say for example, Facebook is charging 5 lakh rupees from you, then you need to pay 6% of it as an equalization levy. The liability was on the recipient of service when it was originally introduced, right? So 5 lakh 6%, 30,000 you need to pay as an equalization levy and file the form number 1 after the end of the financial year before 30th June. And you will be paying the remaining amount 4,70,000 to the Facebook. This was the case introduced by 2016, limited to online advertising only. But the Finance Act 2020 brought a major amendment to this equalization levy, and I would like to say that equalization levy is not covered under Income Tax Act, it is covered under Finance Act, right? So Finance Act 2020 widened the scope of equalization levy, thereby including consideration received or receivable by an e-commerce operator for e-commerce supply or services on or after the first day of April 2020, and is levied at 2% on such consideration and made or provided or facilitated by it to a person resident in India or to a non-resident in a specified circumstances, such as sale of advertisement which targets a customer who is resident in India, or a customer who accesses the advertisement through internet protocol address located in India, and sale of data collected from a person who is resident in India or who uses an internet protocol address located in India. And third, to a person who buys such goods or services or both using internet protocol address located in India. So this amendment brought all the e-commerce aggregators into its net, right? And in this with this amendment, 2% liability of paying equalization levy was put on the e-commerce operator, right? Earlier it was on the service recipient when it was originally introduced 6%, right? Now with this expansion in the scope, they put the liability on the e-commerce operator. Now, what are the conditions under which equalization levy on e-commerce supply or service shall not be charged? Equalization levy on e-commerce supply or services shall not be charged where the e-commerce operator has a permanent establishment in India. Once an e-commerce operator has a permanent establishment in India and it provides such supply or service, then it will not fall under this, right? And such e-commerce supply or service is effectively connected with that PE. Where equalization levy is leviable under section 165. So example which I gave of Facebook, right? If you are covered in that section, then again you are not covered here. Sales, turnover, or gross receipts, or as the case may be, of the e-commerce operator is less than ₹2 crores during the previous year, then in all these three conditions, the e-commerce operator is not required to pay equalization levy, right? What does e-commerce operator? Now we need to understand what does e-commerce operator means. E-commerce operator means a non-resident who owns, operates, or manages digital or electronic facility or platform for online sale of goods or online provision of services or both. What does e-commerce supply or service means? E-commerce supply or service means online sales of goods owned by the e-commerce, right? In 94(o) e-commerce operator, what we studied is that it facilitates the sale of goods and services of the e-commerce participants. This equalization levy covers e-commerce operators who also owns their own goods, right? So online sale of goods owned by the e-commerce operator, or online provision of services provided by the e-commerce operator, or the online sale of goods or provision of services or both facilitated by the e-commerce operator, or any combination of activities listed in clause 1, 2, or Now, due to various ambiguities, there was lot of queries and lot of chaos, and there when this last year this was introduced. So, to an explanation has been inserted in section 163 of the Finance Act 2016, which specifies that consideration received or receivable for specified service, means online advertising and all, or e-commerce supply or service, shall not include consideration taxable as royalty or fees for technical services under which 90 or 90 of the Act. Right, so once a particular income is falls under royalty or fees for technical service, and then equalization levy will not be applicable, and royalty or fees for technical service will fall under income tax. The only logic for this amendment was that to avoid double taxation. Right. Another explanation was inserted under section 164 of the Finance Act, which provides that for the purpose of e-commerce supply or service, online sale of goods and online provision of service shall include one or more of the following activities taking place online: acceptance of offer for sale, placing the purchase order, acceptance of the purchase order, payment of consideration, or supply of goods or provision of service partly or fully. So that might be a case that you are making a physical order of goods with some e-commerce operator. The goods are delivered also physically, but you are just making an online payment using a digital platform. Then also it will fall under this, right? Now, just we have a difference between 94O and equalization levy. Who is liable to deduct and deposit? Here, 94O, e-commerce operator is liable to deduct tax and deposit with the central government. Equalization levy, e-commerce operator is liable to deposit with the central government. What should be the residential status of e-commerce operator? Here, the e-commerce operator can be a resident or a non-resident in applicability of 94O. But here, e-commerce operator should be a non-resident, right? That is very much prerequisite for applicability of equalization levy. What should be the residential status of e-commerce participant? Here, e-commerce participant should be resident in India, then and then only 194O will be applicable. E-commerce participant should be a non-resident, and the sale of goods and provisions of services should not be effectively connected with the permanent establishment in India. So if there is a non-resident having a permanent establishment in India, then the sale which has been made by this e-commerce operator, that will not be included. Who should be the customer? Customer can be a resident or non-resident. Here also can be a resident in India or a non-resident. Applicable rate 1% of the gross amount of sale or service, or both, facilitated by an e-commerce operator. 2% of the consideration received or receivable by an e-commerce operator from supply of goods or services. Now, let us look at one example to have clarity. ABC.com, a non-resident e-commerce operator, makes or facilitates the following transactions. Sale of, there is an ABC.com, a non-resident e-commerce operator, and he has entered into following transactions. Sale of own goods. Nowadays, you might see that Amazon, earlier they used to just facilitate. Now they have started purchasing the goods of the vendors and keeping them in their godowns, right? So the sale of own goods, 100 lakhs. Supply of services through own resources, 250. Facilitating the sale of goods or services by the non-resident e-commerce participant not connected with PE in India, that is permanent establishment in India, 350. Facilitating the sale of goods or services by the resident e-commerce participants, 500. Now let us calculate equalization levy. Sale of own goods, 100. It will be definitely be covered because e-commerce operator includes in this definition includes any goods owned by, right? So 100 into 2%, 2. Services provided by through own resources definitely will fall under equalization levy, 5. Facilitating the sale of goods or services by the non-resident not connected with P in India, definitely it will be covered. And the last, that is facilitating the sale of goods or services by the resident e-commerce participant, it will not fall under 94, it will not fall under equalization levy. Reason being, Finance Act 21 has excluded the consideration received or in respect of sale of goods or provision of services owned or provided by a resident person or Indian permanent establishment from charge of equalization levy. So even if you are a non-resident economic participant but having a permanent establishment in India, then it will not be subject to equalization levy. Now with the same example, we will calculate 94O. Sale of own goods, It will not come because e-com in 94O, the goods belongs to an e-commerce participant, right? So since the goods are owned by the operator, 94O will not be applicable. Same with services. Facilitating the sale of goods or services by the non-resident e-commerce participant not connected here now as e-commerce participant is a non-resident. For applicability of 94O, e-commerce participant has to be a resident, right? Since in the third case, it is a non-resident, 94O will not be applicable. And last, facilitating the sale of goods or services by the resident e-commerce participant. Here 94O will come into play and 501% 5 will be, TDS will be deducted, right? Now moving to the next section, that is TDS from dividends. This also was introduced with the Finance Act 2020. As you all know, from 1st April 2020, dividend distribution tax has been abolished. So now dividends will be taxable, right? So what type of dividends are covered? So dividend shall include the following: final dividend, interim dividend, deemed dividend as referred to in section 2.2, dividend as referred to in section 115 ACA, that is by way of dividends on global depository receipts of an Indian company. Who will be a deductor? Every Indian company or a company which has made the prescribed arrangements for the declaration and payment of dividends, including dividends or preference shares within India, shall be liable for deduction of tax at source in accordance with this provision. Every Indian company will be covered. Who will be a deductee? Tax is required to be deducted under this provision only if a recipient shareholder is a resident in India, where a shareholder is non-resident, and obviously section 195 will be applicable and it will be deducted at the rate of 20%. Now threshold limit, there is no threshold limit. From very single 1 rupee, TDS is to be deducted for payment done for dividend. But however, if an individual shareholder to whom dividend is made and it is made in any more other than cash and it is more than 5,000, then TDS will be applicable. Otherwise, in that case, it is not applicable, right? Rate of TDS. Tax shall be deducted at the flat rate of 10%. If PAN not furnished, again 206AA, again 206AB, in case if return not furnished, and in clash both applicability, higher rate will prevail. Exemption. Now provided further that the provisions of this section shall not apply to such income credited or paid to Life Insurance Corporation of India, General Insurance Corporation of India, or any other insurer in respect of any shares owned by it. Now the Finance Act 21 with effect from 1st April has introduced another, that is a business trust, who is giving dividend to further unit shareholders or even receiving dividend from a specific purpose vehicle. Then also it will not be taxable as their income is exempt. Okay. Now the most important section, which all senior citizens are quite happy with it, but I don't know who will be able to claim the deduction or who will be able to claim this benefit. Let's have a look at it. 94P, TDS from pension and interest income of senior citizen, effective from 1st April 21. Now, who will be a deductor? Every specified bank, right? As will the government, central government will notify. Such bank shall be liable for compute the total income. Now bank, see, they have given a burden now, the compliance procedure on the end of the bank, and how it will go, we don't know. But to compute the total income of a specified senior citizen for the relevant assessment year after giving effect of deduction under chapter 6A and under 87A, and deduct income tax on such total income on the basis of rates in force. So I don't know how bank is going to update their softwares or what they are going to do, because it's a tedious job at the end of the banks to calculate and prepare the returns of the senior citizens and calculate their, compute their tax. Deductee, here a resident senior citizen whose age is 75 years or more at the time of during the previous year. Conditions. Tax is required to be deducted under this provision only if the conditions are satisfied. The income of the deductee. Now these conditions are such that I don't know how it will be fulfilled. The income of the deductee includes only pension and interest income. There can't be any other income. If you have any other, then section 194P is not applicable. So if any senior citizen is having any house property given on rent, then 94P will not be applicable. Any senior citizen having capital gain from shares and secure, then this section will not be applicable, right? The interest should be received or receivable from any account maintained by the deductee in such specified bank. So, and the said bank is in pension income should be received in the same bank. So pension and interest income should be in the same bank to avail this TDS. Benefit of this section. Deductee furnishes a declaration to the bank containing such particulars in such form and verified in such manner as may be prescribed. Threshold limit, no threshold limit has been prescribed for deduction of tax at source, but it is assumed that slab rate will be applicable because they are going to calculate the total income of the by aggregating the pension income and interest income. So slab rate of an individual will be applicable, might be. Time of deduction, again, no time limit has been prescribed, but we can assume that this computation can be done at the year end only. So again, this exercise will be done by the banks at the year end. Now let's wait for some notification from the government. Rate of TDS. Tax shall be deducted at the rates in force. The rate shall be further increased by surcharge and health and education cess. Now the provision of section 184P overrides all other provisions of chapter 27B. Right? Thus, if any tax is deductible under any other section, 94A from interest, then the bank shall deduct the tax under this provision only. Right? So say for example, if your interest senior citizen is there and he is having a interest income of 60,000, but once a senior citizen makes a declaration that he is having this much pension income and this much interest income only, and there is no other income, then that if there is any tax liability that comes, then the bank will be deducting the TDS under 94P only and not under 94A, right? Then where no tax is due on the total income of the specified senior citizen computed by the bank, no tax shall be deducted even if the amount payable by the bank exceeds the threshold limit specified in any other provision. So now here assume that a senior citizen is having a pension income of 3 lakhs and is having an interest income of rupees 1 lakhs. Now just it's cumulatively it becomes to 4 lakhs aggregate, and after giving deductions and rebate under 87A, his total income is below the maximum amount not chargeable to tax. So as such, there is no tax liability. So even though bank is giving an interest income of rupees 1 lakh, they will not be deducting the tax, right? So no tax shall be deductible even if the amount payable by the bank exceeds the threshold limit specified in any other provision. Exemption, where tax has been deducted under this provision, deductee shall not be liable to file his return of income for the assessment year relevant to the previous in which the tax has been deducted. Now 206C1H. Right, this section again was introduced by the Finance Act 2020, but we need to understand to know what is 94Q, which has been newly introduced by the Finance Act 21. So with 206C1H, TCS from sale of goods with effect from 1st October 2020. Now have a look at it, that who will be covered. Now this section 206(1)H is of TCS. You all know TCS, tax collected at source, and here the liability will be of the seller of the goods. So normally there are few things which falls under the liability of TCS. That is when you alcoholic liquor for human consumption. Then if you are into business of scrap sale and you are selling it to the trader and not to a manufacturer, then you are supposed to charge TCS. Then in jewelry, then in motor vehicles, if the amount exceeds 10 lakh rupees of motor vehicle, then 10 due leaves under forest list. Like there are some specific sections for which 206C1 is applicable. Now the Finance Act 20 has widened the scope of TCS by bringing into it another section, that is TCS from sale of goods. So tax shall be collected by the seller of the goods other than those specially covered. So I said if you are in the business of scrap and you are collecting TCS under section 206C1, 1%, then 206C1H will not be applicable, right? So tax shall be collected by the seller of the goods other than those specially covered under any other subsection at the following rates. Sale of goods 0.1%, if PAN or other is not furnished, 1%, and if return is not furnished, then 206AB will be applicable, that is 5%. Now supply of service nil. This means that 206(1)H will purely fall when there is a sale of goods, right? It is not applicable in case of services. Amount on which tax shall be collected. Now tax shall be collected from the sale consideration received in excess of 50 lakhs during the year. Only when sale consideration received in excess of 50 lakhs during the year. Time of collection, the tax shall be collected at the time of receipt of such sum from the buyer. CBDT has now last year the government has come up with the circular to clear out some doubts that were raised after the introduction of this section. So CBDT has clarified that since section 206(1)H applies on receipt of sale consideration, this provision will not apply on any sale consideration received before 1st October. So from 1st April to 30th September, if you have received an amount, then that will not be considered for applicability of section 206C1H. Consequently, it would apply on all sale consideration, including advance, received on or after 1st October, even if the sale was carried out before 1st October 2020. So if you have made any sales on say 25th September and you are receiving any payment exceeding 50 lakhs from a particular vendor, then 2061H will be applicable. Now, who shall collect TCS? A seller who receives any amount exceeding 50 lakhs from a particular vendor. This limit of 50 lakhs applies to each and every individual buyer of the goods, right? So a seller who receives any amount as consideration exceeding 50 lakhs for sale of any goods. And secondly, for application of this section, this only if his total sales, gross receipts or turnover from the business exceeds 10 crores during the financial year immediately preceding the financial year in which such goods are sold. So for applicability of this section, say for in 2021, this has come into picture. Then in 1920, the turnover of the seller is supposed to be more than 10 crores. Then and then only 206C1H has to be applied. So first condition you need to see whether your previous year turnover is 10 crores. Yes, then only the second question you ask yourself whether you have received any consideration exceeding 50 lakhs from a particular vendor, right? Exemption from collection of tax. No tax is required to be collected in the following situations. No tax to be collected by a person who is notified by the central government. No tax is to be collected in respect of sale of goods if tax is collectible from such transactions under section 206C1, 206C1F or 206C1G. So I would just like to give a brief over here that if section 206C1, I give an example of sale of scrap. So you are in the business of scrap and collecting TCS at the time of selling the scrap to the trader, then 206C1H will not be applicable. Two sections cannot be applied on one transaction, right? 206C1F. This 206C1F deals with the sale of motor vehicle exceeding rupees 10 lakhs. Right, so once if 206C1F is applicable when a motor vehicle is sold by a dealer to a end customer, right? It is not applicable between manufacturer and a dealer, right? That is very important to note. 206C1F applicable between dealer to the end customer, and if he is purchasing, if he is selling a motor vehicle exceeding 10 lakh rupees and has already charged TCS under section 206C1F, then 206C1H will not be applicable on that particular transaction. Or 206C1G, that is an authorized dealer receiving amount exceeding rupees 7 lakhs. This was introduced by the Finance Act 20, and if an authorized dealer receiving any foreign remittance from a person who wants to send it to foreign, then in that case again 206C1H will not be applicable. And again another will be in case of overseas tour program which was introduced last year by the Finance Act 2020, right? So no textile. Third is no tax to be collected if the buyer is liable to deduct tax at source on the goods purchased by him from the seller. That we will take in the next slide. No tax to be collected in respect of goods exported out of India. So you are exporting any goods and receiving any payment from outside India, then 206C1H will not be applicable. From whom the tax shall be collected? The tax shall be collected from the consideration paid by the buyer of the goods, where the aggregate value of sale consideration received in a financial year exceeds rupees 50 lakhs. However, tax shall not be collected if the buyer is a central government, state government, embassy, high commission, education commission, a local authority, a person importing goods in India. So export-import exempted from both cases, any other notified person. Now, the CBDT, there was a lot of confusion last year because it was postponed, and finally it got introduced on 1st October 2020. So CBDT had come with certain guidelines by the circular number 17 dated 29/9/20. It specifically has stated that the applicability on transactions carried through various transactions 206C1H will not be applicable. Reason being, buyers and sellers do not have one-to-one contract. Applicability of sale motor vehicle. So normally 206(1H) and 1F are different. 1F is based on single sale of motor vehicle. 1H is for receipt above 50 lakhs during the previous year against aggregate sale of goods, right? So if a dealer is making payment to a manufacturer, so if we take a manufacturer Maruti and your dealer is Kiran Motors, right, and they are making a payment of rupees 50 lakhs exceeding for the cars that they have purchased during the year, then 206C1H will come into play, right? But if a dealer, that is Kiran Motors, is selling a car to X person and the value of car is more than 10 lakhs, then 206C1F will be applicable, right? So well, subsection 1F is for sale to a consumer only and not to dealers. Subsection 1H is for all sale above threshold. Hence, in order to remove the difficulty, it is clarified that receipt of sale consideration from a dealer would be subject to TCS under section 2061H of the Act if such sales are not subjected to TCS under subsection 1F of section 206 of the Act. In case of sale to a consumer, receipt of sale consideration for sale of motor vehicle of the value of 10 lakh rupees or less to a buyer would be subject to TCS. So take an example that a person during the year has purchased 6 cars from a particular dealer, and every time the value of the car is less than 10 lakh rupees. So every time 206C1F was not applicable as the value of motor vehicle was less than 10 lakhs. But during the year the aggregate value cross the 50 lakh rupees, then 2061H will be applicable even in between the dealer and the end user, right? In case of sale to a consumer, receipt of sale consideration for sale of a motor vehicle of a value exceeding 10 lakh rupees would not be subject. Obviously, 206C1F will be applicable, right? Adjustments for sale return, discount or indirect taxes. It is hereby clarified that no adjustments on account of sale return or discount or indirect taxes, including GST, is required to be made. Reason being, the collection is made with reference to receipt of amount of sale consideration, right? Here it is not in relation to issue of invoice. So you are supposed to collect TCS only at the time of receipt of sale consideration. So at that time you don't have to think of GST or any sales return. Once deducted, right? You have to collect it if it crosses the threshold limit. Fuel supplied to a non-resident airlines, it is provided that provisions of subsection 1H of section 206C of the Act shall not apply on sale consideration received for fuel supplied to a non-resident airlines at airports in India. Now 194Q, then we will have an interplay between that is the main today's topic of 94. So 94Q, TDS on purchase of goods effective from 1st July 21, introduced by the Finance Act 21. Now, who will be a deductor? A buyer is required. Am I okay? My speed is okay now? Everyone is with me now?
Yes, ma'am.
Yes. Okay. A buyer is required to deduct tax at source under this provision if the following conditions are satisfied. He is carrying on the business, right? First condition is he is carrying on the business. That is required, right? If you are doing for a personal use, then this section will not be applicable. He is carrying on the business. He is paying any sum to a resident person for purchase of any goods. Total sales, gross receipts or turnover from the business exceeds 10 crores, same which was there in 206C1H during the financial year immediately preceding the financial year in which such goods are purchased, and goods are purchased for a value or aggregate of value exceeding 50 lakhs in any previous year. So now 206C1H TCS provision was applicable to seller, 94Q TDS on purchase of goods applicable to a buyer. Who will be a deductee? Obviously, the deductee is to be a resident person being a seller. Rate of TDS. Tax shall be deducted at the rate of 0.1%, same rate as was there in 206C1H. Again, PAN not furnished 206AA, return not filed 206AB. In case of applicability of both the sections, higher of the rate will prevail. Time of deduction. At the time of credit of such sum to the account of the seller or at the time of payment thereof by any mode, whichever is earlier. There 206C1H will be applicable only at the time when you receive the consideration. Here, once you book an invoice, the liability will arise. Amount on which tax is to be deducted. Tax is required to be deducted from the purchase value exceeding rupees 50 lakhs. Same provision that was there in 206C1H. Exceeding 50 lakhs, you are supposed to deduct TDS or collect TCS. Exception. No tax is required to be deducted under this provision if the tax is deductible, right? So TDS, or collectible means TCS under any other provision except 206C1H. So say for example, e-commerce operator has deducted the tax of e-commerce participant. Then even if a participant is purchasing, then also the 94Q will not come into play for the same transaction, right? Once another provision is applicable for a particular transaction, then 94Q will not be applicable. Or if you assume that 206C1F is applicable, that is for motor vehicles, then 94Q will not be applicable. So no tax is required to be deducted under this provision if the tax is deductible or collectible under any other provision except section 2061H. Thus, if a transaction is subject to TCS under section 206C1H, the buyer shall have. Now there can be a case where both 206(1)H and 206(94)Q both will be applicable. Then in that case, the buyer shall have the first obligation to deduct the tax. If it does so, the seller will have no obligation. However, if a buyer makes a default, the liability to collect tax gets shifted to the seller. Right? When can that be? Now we will take in the example. Other aspects. Now let me first complete, and we are doing other aspects. Threshold limits for financial year 21-22. So what would be a threshold limit? Again, 206C1H last year when it was introduced in between. Same thing was here also. 94Q is going to be introduced between 1st July 2021. So there will be a question at everyone's end that whether the turnover between 1st April to 30th June is to be included for considering the threshold limit. Yes. Turnover from a vendor should be considered for computation of threshold limit, but not for deduction of tax. Say, for example, you have purchased the goods of rupees 40 lakhs between 1st April to 30th June from a particular vendor. Why? Right? After 1st July, you are making another purchase of 20 lakhs. Right? So here 40 plus 20 aggregate, it became 60 lakhs. So for considering here TDS 94Q will become applicable because aggregate it costs 50 lakhs, but TDS will be deducted only on 10 lakhs. 60 minus 50, 50 lakhs is the threshold limit. So only 10 lakhs TDS will be deducted on only 10 lakhs. Okay. Next. Threshold limit to be tested every year. Yes. Threshold limit even in 206C1H and even in 94Q, threshold limit of 10 crores into turnover of rupees 10 crores in the previous year and 50 lakh every time is to be checked. Whether tax to be deducted on GST component. Now in 206C1H, CBDT has specifically said that while considering the amount, no effect is to be given to the GST or the GST component or the sales return or debit note, credit note. The reason being TCS is to be collected on the receipt, on the consideration, right? Here that might be a case that you are getting an invoice where GST is also there. So basic plus GST total amount. So there is a query that whether tax is to be deducted on GST component. Now there are lot many case laws and lot many judgments, and many times there have been a clarification that for collecting service tax or GST, normally the buyer acts as an agent of the government. So not following the same analogy, we can avoid the tax on GST component and we can deduct the TDS on 94Q basic amount only, right? Applicability of provision to new business. Now 94Q specifically states that in the previous year your turnover should be more than 10 crores. So if it's your new business, then obviously you don't have the data of previous year, right? You don't have the database, you obviously have zero turnover. Then 94Q will not be applicable in the first year of your business. Purchase of goods from sellers located in SEZ EOU. Now, this section has not made any distinction between a domestic buying from a domestic market or from SEZ or EOU. So even if you are purchasing goods from SEZ, you need to apply 94Q if other conditions are fulfilled, and they will be claiming the refund as they are not taxable under income tax. Payment in kind. Now, normally 94Q states that any sum for purchase of goods, thus it requires monetary payment. So at the time of making monetary payment, 94Q will be applicable. Purchase of capital goods or fixed assets. Again, there is no distinction in this section between a capital goods and fixed assets. So if other conditions are satisfied, then 94Q will be applicable even in case of capital goods. Composite supply of goods or services. Now 94Q specifically states that once TDS is deductible in any other section, then 94Q will not come. So if it's a composite supply and TDS is deductible under 94C, then 94Q will not be applicable. Now interplay, which I have been asked to cover today for interplay between 94Q, TDS and section 206C1H. Who is liable? So 94Q, we all are here. I hope you all are with me.
Yes, ma'am.
Yes.
Yes.
So 94Q, buyer is liable to deduct TDS. TCS 206C1H, seller will be covered. Turnover limit in both the cases. In the previous year, the turnover should exceed 10 crores immediately preceding the financial year in which such goods are purchased or in which the receipts are consideration is received. Threshold limit or purchase limit. If the value of purchase exceeds 50 lakhs, here the value of sales exceeds rupees 50 lakhs. Rate consideration 0.1, 0.1. Amount on which tax to be deducted on the amount of purchase in excess of rupees 50 lakhs, on amount of sale consideration in excess of rupees 50 lakhs. Now, at the time of credit or payment, whichever is earlier, because in this case 94Q, you will be getting the invoice earlier and might be making the payment later on. So at the time of credit or payment, whichever is earlier. Here at the time of receipt, obviously, because 206C1H will come in play only at the time of receipt of sale consideration, right? Preference. Now, in case assume that 94Q is also applicable to buyer and seller is also falling under 206C1H, then in that case preference will be first, liability for deducting tax will be of the buyer under 94Q, right? So purchaser is first liable to deduct TDS if the transaction could be subject to this provision. Seller shall be liable to collect tax only if the purchaser is not liable to deduct TDS or purchaser has failed to deduct the TDS. Now, some tricky situations. Let's have a look at some tricky situations. Situations where buyer and sellers are having turnover in excess of rupees 10 crores in preceding financial years, right? And are covered by section 94Q and 2. So both are having the turnover in the preceding financial year exceeding rupees 10 crores, right? And to both of them, they are covered under 94Q and 206C1H respectively. So buyer has purchased goods or has made advance payment. So first liability, buyer has made goods exceeding rupees 50 lakh, then first liability will be of the buyer. So 94Q will be applicable. 206(1)(h) will not be applicable. Reason being, buyer has deducted the tax under 94Q. Second situation, buyer has paid the dues out of the payable balance as on 36/2021. So there is some opening balance as on 1/7 and he is making such payment, then buyer would not deduct TDS. Seller would collect the TCS. Here seller will deduct TDS if the amount sales consideration with that particular vendor exceeds rupees 50 lakhs, right? Third thing, buyer has bought the goods but returned later on without crediting in the seller's account. Now, actually, this might be a situation where even he has not booked in the books of accounts, because even if you booked in the suspense account, liability will get attracted. So in third situation, we are assuming the goods have been received, but it has not been booked anywhere. Then since he has not credited or made the payment, no obligation to deduct TDS, and here also no amount received, so 206(1)(h) will not be applicable. Now, buyer has bought the goods, but return later on after crediting in the seller's account and debiting on the return of goods. So there is a sales return by the buyer. So if you are aware that in TDS there is no such provision of giving effect to sales return, just like we have in our GST, right? So once TDS deducted, now you can't revise, or you can revise it, but not in that way that since you have returned the goods, you can reduce the TDS. That is not a provision in TDS. So TDS would have to be deducted from the credit amount despite subsequent debit by way of return of goods. Therefore, accounting entry of credit should be passed after full acceptance of goods. No amount received, so 206(1)(h) will not be applicable. Now, buyer was liable but did not deducted the TDS, right? So buyer has defaulted. So here seller will come into play. Seller would be liable to collect TCS as second proviso to section 206(c)(1)(h) fails to operate. Now you will ask me, how the seller will come to know that the buyer has deducted or not deducted? Obviously, first you are making a sale to a buyer. So the first thing that will be done is if buyer is falling under the provisions of 94Q, then he will deduct TDS and intimate to you. And if he's not, or at the time of making a payment, he will deduct the TDS and make the remaining payment to you. So your stage will come at a second stage. Seller will come at a second play, right? So if buyer doesn't deduct it, or buyer doesn't fall under the conditions of 94Q, then seller will be required to collect TCS under section 206(1)(h). Both sections will not be simultaneously be applicable, right? Now, practical scenarios on applicability. Turnover of buyer and seller in the preceding year exceeds 10 crores and the purchase exceeds rupees 50 lakhs in the current year, right? So it is a case where the turnover of the buyer and seller exceeds rupees 10 crores. So both are liable for, both are falling in 94Q and 206(c)(1)(h), right? And the purchase exceeds rupees 50 lakhs. So here, who will be applicable first? The liability of the buyer. So buyer would first deduct the TDS at the rate 0.1% under 94Q. Second condition, the turnover of the buyer exceeds 10 crores in the preceding year, but that of the seller is less than 10 crores, right? And the purchase exceeds 50 lakhs in the current year. Obviously, seller will come afterwards. First, buyer's conditions are satisfied, so he will deduct TDS under section 194Q. the turnover of the seller exceeds 10 crores in the preceding year. However, that of the buyer is less than 10 crores and the purchases of the buyer is more than 50 lakhs in the current year. So here 94Q will not be applicable because buyer turnover in the previous year doesn't exceed 10 crores. So when the first condition fails, buyer applicability of 94Q will stop there, right? So now the liability of the seller will come. So now seller will be required to collect TCS under section 206C1H at the rate of 0.1%, assuming that the entire amount has been paid. The turnover of both the buyer and seller is less than 10 crores. There might be a situation that both the buyer and seller's turnover in the previous preceding year is less than 10 crores and purchase exceeds rupees 50 lakhs. Then in that case, since the first condition of applicability of both the sections are not fulfilled, neither the buyer nor the seller will be liable to collect or deduct TDS or TCS, right? Now, other amendments, I have just covered 2-3 amendments. Section 194A3X has been amended with effect from 1st April to include infrastructure debt fund. So 94A is interest other than interest on securities, and 94A3 is the provision that considers the exemption list who are exempted from 94 applicability of section 94A. So one more 94A3 has been amended to include infrastructure debt fund also within its purview, so as to provide that tax shall not be deducted on income in relation to zero coupon bonds issued by the infrastructure debt fund. Now another is 94IB. Now IB was introduced by the Finance Act 2017. And in that, if you remember that again, in that it was said that if any individual or HUF having only salary income or any other income, or not doing into business but not into audit, and making monthly payment of rent exceeding rupees 50,000 will be required, whether it's for rent, individual house or for business house, will be required to deduct TDS under section 194IB. Right? So that was the case. 94IB was introduced by the Finance Act 2017. Again, in that, if PAN not furnished, then the tax shall be deducted at the rate prescribed under section 206AA, subject to the condition that the amount of TDS cannot exceed the amount of rent payable for the last month. So there was a condition that at the time of deducting the TDS under 94IB, it is to be deducted at the year end, in the last month, or at the time of vacating the property, right? Whichever is after. So cannot exceed the amount of rent payable for the last month of the year or the last month of the tenancy, as the case may be. So since 206AB has been introduced with effect from 1st July, so a subsequent consequent amendment has also been made in section 94IB, that to provide that in case the tax is required to be deducted at the higher rates as prescribed under 206AB, then the amount of TDS cannot exceed the amount of rent payable for the last month of the year or the last month of the tenancy, right? So aggregate value, and after applying 206AB at the rate of 5%, if the amount of TDS works out higher than the last month rent, then it will be up to the last month rent. It cannot exceed that amount. Okay, I have done with my presentation. Thank you so much. Hello.
We would request from the participants in case we have any questions to be addressed. I think 2-3 questions.
I'm just checking the chat box.
Yeah.
If it has been mentioned, then I'm taking it. Let me check. How will be the deductor know that the payee has not filed a return in the past 2 years? From Poonam Javeri. Okay, I have said that the government has provided the utility, right? And even in the case of individual cases, now we can check it whether they have filed the return or not, right? So we need to take the declaration in case of other cases other than bank, post office, or cooperative bank. We need to take a declaration whether he has filed a return or not. Then can't see the lower part of TAN number not required. Where I just can I Mala Rajpal, where you ask me, so can I just know? Payment shall be made through PAN only. In case of joint owner, how is the limit to be checked? From plain reading of the section, we can say that limit is per person, right? I think this question is related to 94N. In case of joint owner, how is the limit to be checked? right? So from the in case of joint accounts, from plain reading of the section, we can say that limit is per person in case of joint account, but we expect some certain clarifications from it. Non-resident to non-resident for equalization levy for Amazon. Yes. How will the seller know that the buyer's turnover is less than 10 crores? Here buyer seller will actually at the time of seller will come to know definitely, because first initiative will be taken by the buyer whenever he will purchase the goods and the limit from a particular seller exceeds rupees 50 lakhs, right? And if he deducts the TDS, and the seller will definitely come to know that he has deducted the TDS, and so now 2061H will not be applicable in that case. And if that is for better clarity, we can even take a undertaking from the buyer.
मैम
हाँ
मैम इन केस ऑफ जॉइंट ओनर फिर अभी कोई क्लैरिफिकेशन नहीं है तो कैसे करना है?
So we are waiting for it, how it will go definitely, because now in interest also they used to like any FD hold jointly, then the first name they used to deduct TDS, right? So here also they will consider it how they might consider the first name for deducting TDS, but now let's wait. It is very early to say. Let's wait for some CBDT clarification.
I think Anju but has posted one question, that is non-resident e-commerce operator to non-resident application of equalization levy.
Just let me move it. Wait a minute. I'm just my now. What is the question? Can I just know?
Yes. She has mentioned that non-resident e-commerce operator to non-resident application of equalization levy.
Okay, see, I would like to just give an example if it can help you. See, if an XYZ Mobile is a manufacturer of mobile company, right? Now he's into a manufacturing of mobile phones. Now he's selling the goods from his own website, right? And even he's to the customers in India, and even he's registered with another e-commerce operator operating from another country, right? So e-commerce operator in another country, say USA, will be required to charge to collect equalization levy and pay it for the sales made by it for the residents for the e-commerce participants. But for the sales done by the another e-commerce operator, he will not be liable. The another e-commerce operator will be required to pay. Hello.
Yes. Any of the participants, in case having any query, may please unmute themselves or can even put it in the chat box.
Thank you so much to everyone for patiently listening to me, and I hope I was up to your expectations.
Pranali, you can definitely see the chat box is flooded with all the appreciation and praises. Definitely, it was a very good session. I, on behalf of Ahmedabad branch of ICI WIRC, extend thanks to you, and we are very thankful for devoting your valuable time in guiding on the topic. It was, you definitely put it up all the details. You covered all the details, and that too in a precise manner. It is definitely, it went a very well session. Once again, we thank you on behalf of the Ahmedabad branch.
Thank you so much, and even I would like to thank you for believing in me and giving me this opportunity. Thank you so much.
Yes, we really look forward for more and more sessions with you.
Thank you so much. Thank you, ma'am, and thank you to all the participants. Thank you so much.
Thank you.